From Beverly Hills, California, to our viewers and listeners worldwide, welcome to the first day of our special coverage from the 29th Annual Milken Institute Global Conference here in Los Angeles. I'm Romaine Bostick.
And I'm Katie Greifeld, and we have a ton of big names joining us over the next 3 hours, including Senator Ted Cruz of Texas.
And we're also going to hear from IBM Vice Chair Gary Cohn, who, of course, also used to work in the old Trump administration.
Right, yeah, I've heard that. We're also going to be speaking to Walsh of Guggenheim Partners, and really, we just have an embarrassment of riches when it comes to smart, insightful conversations today.
Absolutely, and we talk about really kind of this mashup of what we've seen in the world, Wall Street, Main Street, of course, what's going on in Washington, a broad macro story. It's not just a U.S. story, it is a global story.
Indeed, and it's not just a single asset story, it's a lot of oil, and it's a lot of the cross-asset impacts here.
We're going to be here for the next 3 hours broadcasting here from the Milken Conference, and we want to kick things off here on this Monday with Robyn Grew. She's the CEO of Man Group, the world's largest publicly listed hedge fund manager, a more than $200 billion multi-asset, multi-strat platform that gives her a wide lens into what's going on in the world and how best to invest it. Robyn, great to have you back.
Thank you for having me.
All right, so I'm going to start with the macro, because based on what you do, based on what Man Group does, you probably have that nice sort of bird's eye view of what's going on out there in the world. I would assume in one sec, this is good for business.
In one sect it is, but it's a fascinating time. You know, these are difficult times. The macro picture of what should be happening, what should be reflecting, the data is telling us, somehow isn't sort of reflecting itself. You're not seeing supply chain shock in the way that you might have expected. The S&P continues to go from strength to strength. Prices are really going up. You know this and I know this. You fill up your car with gas, it's more expensive than it used to be. And yet you have this optimism in the market. So it's a really interesting time, and it presents opportunities.
But talk about that dislocation, right? Yeah. Because what's going on the ground for a lot of people is a lot different than what's going on if you're an investor or a trader, a professional trader.
That's right.
Yeah.
And it's that dislocation is real. I mean, every conversation I'm having right now with the biggest allocators all over the world, with economists, with bank analysts, with anybody you want to talk to, because we do talk, we're all sort of circling the same stuff. Data is saying, listen, if this Iran conflict goes on longer, the feel and the pain of this could be felt. You saw what happened with central banks last week. Everybody's a little bit on pause. The inflationary numbers feel a little bit less good. You are starting to see growth dampening. You're seeing literally manufacturers stopping production in certain items. You're seeing airlines saying, hang on a second, we might be needing to cancel flights. And at the same time, you have this big tech story, which is dominating, particularly the US markets. So in that, there's some really interesting data points, and it is a bit of a dislocation. It does feel slightly dislocated. Is this a temporary thing, or as this thing goes on longer, is it going to be felt for longer? Because this isn't just about gas or oil. It isn't about just one item. It's the helium, it's fertilizers, it's a bunch of supply issues that matter to agriculture. It matters. You can see the pain in Europe right now, much more manifest than you can see it in the US. Also an interesting time.
So when do you think that if at any point works its way into U.S. markets? Because you take a look at the S&P 500 in a vacuum, higher by 10% in April. You have no idea what's going on with oil or what's going on in the Treasury market. And I just wonder, you know, how long that can persist. If we have, you know, American big tech performing the way it has, does that necessarily need to sort of come back together?
You know what? I'd love to know the answer to that question. That would be terrific.
I was hoping you'd tell me.
And if I had it, I would tell you, I promise. So let me do it a slightly different way. All of us, have more data available to us, more ticks, more reporting, more capable analysis than we've ever had before, and yet we have perhaps the same levels of inefficiency in markets right now. So as I sit down with CIOs across the world, we have this conversation, not dissimilar to the conversation we're having now, which is, well, what do we do? Do we try and time the market? I'd never known that worked so well. Or do you try and build resilience? A little like countries are trying to build resilience now. And whether it's setting up a sovereign wealth fund in Canada, or whether it's that fiscal stimulation in defence, you're seeing a desire to move towards resilience, and you see that at the country level, but you also see it at the portfolio level. How do we build portfolios and capabilities that are uncorrelated, that are diverse, that have a long-term view, but have the ability to be dynamic and tactical to take advantage of some of the dislocations that we could see coming down the pipe?
I am curious. You mentioned the Canadian sovereign wealth fund. Do you anticipate we're going to see more nations, the ones that don't have sovereign wealth funds, fall in that direction?
It's a great question. I think that Canada has done something quite interesting, and the difference with that particular sovereign wealth fund, as opposed to others you might see, is an absolute focus on supporting the infrastructure within Canada. So you're seeing a version of that in fiscal stimulation, defence locally. You're seeing a version of that with UAE, trying to find less dependence upon other providers. So I think you are going to see a bit of difference in the way that people are trying to tackle that same outward objective, which is how do we work in an economy where we do have global interdependencies, you can see it in the supply chain, and yet we want to feel less pain in the event that these things start to be pressured. Same thing with portfolios. How do you build a resilient portfolio? How do you take advantage of the uncorrelation in products, especially when things like equities and bonds are sort of doing similar stuff right now? And by the way, with stimulation, with this opportunity comes opportunities beyond the shores of the United States. And that's interesting.
And I am curious, you talk about building resiliency, you talk about, being able to take advantage of the dislocations. Are those one and the same thing, or talk us through that a little bit more?
A little bit the same thing. I think the danger is to think about this in too binary a way. I think that none of us are able to really understand how long this war is going to go on for. By the way, we do have another one as well going on that hasn't been spoken about for some time, really doesn't get top billing anymore with Russia and Ukraine. You do have issues that are around how other countries are feeling growth and GDP sort of smoothing out. You do have fiscal issues, you do have government debt, and you are seeing emerging markets actually have a different more conservative approach to debt fiscally, actually operating through that perhaps more effectively. So dislocations are one thing. You do see opportunities. If you take particular asset classes, what you're seeing is not just volatility, but dispersion within those asset classes. And that's where I think there is an ability to take advantage.
All right, Robyn, it feels like we're just getting started. Unfortunately, we have to leave it there. Hope to continue this conversation soon. That is Robyn Grew. She is the CEO of Man Group. Super interesting conversation, especially when you consider how few publicly listed hedge funds there are. Certainly a rare breed, but
we didn't get to talk about all her tech stuff, AI stuff, everything else.
I know.
So we could have just done her for the entire show.
I know. I hope we have her back soon. But I guess we should take a look at these markets right now, because you take a look at Brent. We were higher than 115 a barrel earlier today. You can see that we've taken back some of that, but still higher by about almost 5% when it comes to Brent. That is certainly having an impact when it comes to equities, which
Are you surprised, though, that we haven't had more of a reaction, though? I mean, 5% back to 113, and we were higher. I mean, we were up by 120, what was it, a week or two ago. So given what transpired, you would think that the market would react a little bit more heavily.
Yeah, absolutely. I mean, 0.3% lower on the S&P 500 certainly doesn't feel like much when you think about the April that we've had. And same goes for the NASDAQ 100, where all your big tech names live. All your big tech names live. And just a reminder, we are going to get some more tech earnings tonight. Probably the two most consequential are going to be Palantir and ON Semiconductor. Yeah, it's going to be interesting to see some of those numbers come through. And we should point out the 10-year Treasury yield higher by about 7 basis points. What are transports right now? I wish I could tell you, but let's move swiftly along here, because our next guest sitting to my right, he has a key perspective on the cross currents swirling in asset management from his position at Goldman Sachs Asset Management, announcing a partnership today with Anthropic, helping it launch an enterprise AI services firm alongside Blackstone and Hellman & Friedman. His name is Marc Nachmann. He is the global head of asset and wealth management over at Goldman Sachs. Marc, it's great to see you.
Good to be here.
It's hard to know where to start with you, but I think it makes the most sense to start with the partnership that you announced today. In partnership with Anthropic, makes sense from their perspective. They're really trying to get more enterprise customers through. But talk to us about the benefit that this brings to Goldman and some of those mid-market companies that you work with.
Sure. I mean, I'd start a big picture here. I think when you look at this AI technology from coming from a number of players. It's just staggering in terms of the impact it will have, and it's probably the most significant technological development in certainly the last few decades. And so what I'd say is really interesting is you see the models getting better and better. And I think what businesses really have to do is figure out how to incorporate them into their workflow, how to change their workflows, how to think about business opportunities coming from them. And I think that's a big thing that we're trying to do with our portfolio companies. And we were very focused on that value creation for the portfolio companies. And so one of the things that we wanted to make sure is that we have enough forward-deployed engineers and enough access to models to be able to do this with portfolio companies. So this is a good way for us to get that access, and we're going to continue looking how to improve what we can do with our portfolio companies.
Right. And so AI, obviously an opportunity from that perspective, but I want to talk about the disruption that it's causing in the market, particularly when it comes to private credit, which of course is the talk of the town here in Milken. You think about some of the warnings that we've seen, your former CEO, Lloyd Blankfein, coming out and saying that there's a fire risk here. We heard from Jamie Dimon in the past week talking about a credit downturn potentially being worse than people are expecting. I wonder where you sit on that topic and whether or not these fears are justified.
Yeah, I'd say one of the things that's important to do, in my mind, is to segment this issue into two topics. There's a fundamental credit question, and then there's a question around some of the retail vehicles. And sometimes these two topics are getting intertwined. I think when you stay on fundamental credit, I would say that, both, you think about it, there are three real players in that. They're the banks, they're the public credit markets, they're the private credit markets. All of them provide credit to the economy. And I would say all of them, when you look at it, it's been since 2008 when we had the last credit cycle. What usually happens is right after the credit cycle, underwriting standards are very, very tight. And then the longer you go away from there, they're getting a little bit looser. I think they got looser in banks, they got looser in the public markets, they got looser in the private credit markets. Hard to tell yet whether or not have they gotten too loose or not. I think we've seen some isolated examples, but we haven't seen anything broader. I think when you look at the broad universe of our portfolio that we look in our private credit portfolio, it looks still pretty good. I think when I look at our private credit portfolio, we have a non-accrual rate that is around 50 bips. That compares to kind of 200 to 250 bips for the average BDC. So, but they're still pretty low, and so there's obviously a concern on software and what the impact is on AI. I think that'll have impacts in certain places. We got to keep remembering when we talk about private credit, you talk top of the capital structure, secured deals, and so I'd say in my mind, the fundamentals around private credit still are pretty good if you have a diversified portfolio. I think, interestingly, the lower flow of retail money into private credit has caused yields to go back up again. Mm-hmm. And so when you actually look at it right now, you can kind of get unlevered returns around 10%.
You think the yields are going to go back up, though?
Well, they have over the last few weeks. Mm-hmm. So unlevered returns right now on deals that we're just signing right now around 10% for senior secured leverage. And so one of the things we've seen is we've seen a tremendous amount of interest by our institutional clients into our private credit business. Most of our, 80+% of our private credit business is institutional. So we had a very strong first quarter in fundraising for private credit amongst the institutional client base. So I continue to see the risk rewards pretty good in private credit. Now then, the second issue is really these retail vehicles, and I think the question is all there about illiquidity and how well was that communicated. Yeah. And I think one of the things that we spent a lot of time about, we saw a bunch about that. We're not using the word semi-liquid, for example, in our communication. But it's important that when people buy private assets, that they understand they're illiquid, and it has to have a certain part in the portfolio that you can have a certain part that is illiquid, and you don't need the money for a while.
All right, Marc, we have to leave it there. Great conversation. Hope to have you back. Marc Nachmann there, Global Head of Asset and Wealth Management over at Goldman Sachs. Now, when we come back here from the Milken Conference here in Beverly Hills, a conversation with U.S. Senator Ted Cruz. That's coming up next here on The Close at Milken on Bloomberg.
Well, our next guest, more than $600 billion global asset manager, is growing fresh off its first acquisition last month. Joining us, I'm pleased to say, is Kate Burke. She is CEO of Allspring Global Investments. Kate, great to see you on site here at Milken.
Thank you for having me. Great to be here.
So I was looking back at our records. You took over as CEO last July. Mm-hmm. We spoke to you in December, and the conversation was very focused around how Allspring is focusing on your knitting. You're focused here on public markets rather than chase what's going on in private markets. Those were your comments from December, and I have to imagine you're pretty pleased with that strategy.
Well, look, I think for us right now, it is absolutely the right strategy for us to be pursuing. There is a space in the public markets for a premier player to be very focused in investing back into what is still largely 60 to 70% of any asset allocation strategy is still on the public side. And so to be investing back into those teams, the resources around that, we think can be a real differentiator in the market. And then we'll let the privates play out. I think there's still obviously great opportunity within that space, but something that we're happy to sit on the sidelines for now.
Right. Not necessarily for Allspring there. So sticking to your knitting, you're still expanding here and you're growing. In mid-April, you announced that you would acquire the investment team of GIA Partners. That's a shop that really specializes in emerging markets debt. So talk to us a little bit about how you're looking at M&A right now and what you would need to see. What's your scope for further deals?
So when we looked at the M&A world, again, because of the public market focus, our fixed income franchise is incredibly important to us. So we have between our money markets and fixed income and stable value, almost $500 billion in assets under management. And there are a few places when we look over the breadth of the team that we said we could use additional resources or capabilities. Emerging market debt was a big piece of that for us. We think as a global player, you want to have that exposure. There's other areas still in the market, whether it's moving up into opportunistic credit, we think would be additive to our platform. And then on the equity side, still around the global equity area is a team that we're still looking for. But we think there's going to be more M&A in the space. Small tuck-in deals like the one we just did, we think there'll be more of that. It's so important right now in terms of having the distribution strength, the relationships with the intermediary and the institutional client base, as well as the investments we're all making right now back into our tech and operating platform and the investment in AI.
You said small tuck-in. Any bigger ambitions in terms of M&A?
I think we're always open to looking at what makes the best fit for us. I certainly think that that's a possibility. There was a period of time where people did not want to have large size M&A sort of equal transactions. I think there's a change in dynamics right now in this space. People have done a lot of work around improving their operating infrastructure, would make the knitting of those two together, to use the knitting word, putting those two together would be less complex, I think, than they would have been in the past. And so I wouldn't be surprised to see if there's some opportunities in that space as well.
What about for your business yourself? I mean, it's been a few years since you were spun out of Wells Fargo. I would assume GTCR, Reverence, or maybe looking for some type of exit? Are we talking IPO? Are we talking sale?
Well, IPO would be interesting. I don't know what the public, we just talked at one of the earlier sessions about the fact that companies are staying private for longer. I don't know what the appetite is yet for another asset manager in the public markets.
But you're killing it. I mean, what you've built over the past few years.
We are building a great business, and I think that there's certainly opportunity. But that's one of the great parts about our ownership structure is while it is private equity, they have a very much growth mindset. Their view and our conversations is we see there's a lot of opportunity for us to still grow inorganically and organically and continue to build on the success of Allspring. And so I think we'll continue to be opportunistic in what we're looking to do, and we'll see what else comes around in the marketplace.
What about your relationship with Wells Fargo? I mean, they still have a stake. They're also a client.
They are a great client.
Okay.
Yeah, what I think is interesting and maybe was not anticipated when we spun out is that post the transaction, we actually have continued to grow together. So the relationship is as strong, if stronger than it's ever been. The businesses, we continue to invest with them, help bring ideas to bear with them. We did a direct indexing campaign with them recently. So really bringing our best capabilities. We know their advisor base, over 90% of their advisors have an Allspring product. So when they want to get something done, we are a great partner to them in achieving that. So it's been a terrific relationship.
And Kate, before we let you go, I do want to talk about sort of this forward trajectory of Allspring under your leadership, because you go back to your assets under management. As I mentioned, more than $600 billion, nearly $500 billion of that is fixed income assets. And I wonder, how you're thinking about the equity market, whether or not, that's something that you're looking to boost in addition to your fixed income prowess.
Yeah, active equity management has had a tough go of it. There's so many structural reasons we can talk about, whether it's the mutual fund vehicle that limited your opportunity, or just the number of companies that are staying private for as long as they have, so the universe has gotten smaller. But I still think that there is a real place for active management when we talk about peak passive, and when do you want to be more active. And I think when you see dislocations in the market, this is the time where active management needs to prove itself and really shine. But I do think there's opportunities for us to continue to grow on the equity side.
Kate, real pleasure to have you.
Thank you again for having me.
Thanks for taking time for us. Kate Burke there, the CEO of Allspring Global Investments. Now, we do want to check in here on the markets, basically about, 11:22 here in Los Angeles. And of course, New York is 3 hours ahead. So they've had a lot of time to digest sort of what transpired overnight, the situation in the Middle East. And you see it there on your screen. You start at the bottom, Katie, that 6% jump that we're seeing right now in Brent crude prices.
Yeah, you can see that sell-off in the equity market, maybe deepening a little bit into the close. But all in all, I mean, resiliency is still the name of the game when it comes to the U.S. equity market, because you think about the disruptions that we saw over the weekend, that question about the ceasefire, does it still hold? To see just a 0.4% drop in the S&P 500, not too dramatic, especially when you consider not just what's going on in oil, but what's going on in the Treasury market as well. Absolutely. And of course, politics has continued to dominate what's been going on Wall Street. And despite that, of course, the S&P is still holding near a record high. Now, we do want to talk a little bit more about politics. Joining us right now, fresh from his Milken panel on economic mobility, is U.S. Senator Ted Cruz. He's chairman of the Senate Commerce Committee, who actually controls the legislative agenda on AI, tech, regulation, space, transportation, consumer protection, just about everything else. Great to have you here, Senator.
It is great to be with you. Thank you for having me.
Before we get to economic mobility, before we get to your role as chairman, I do want to ask you about the situation in Iran.
Yeah.
And about the potential for some sort of resolution, some sort of closure to what is now a more than 2-month-long war. What happens?
Look, we will see this wrap up, and we will see it wrap up in time. In 2 months, we've already had extraordinary success. If you look at the military objectives that President Trump laid out right at the front end, Iran's air defenses have been utterly destroyed. Their ballistic missiles and the ballistic missile manufacturing capability completely gone. Their drones and drone manufacturing capability destroyed. Their Air Force in complete rubble, and their Navy sunk on the bottom of the sea. The Ayatollah is dead. The mullahs are dead. Just about every senior military leader is dead. In terms of military successes, it took Iran 40 years to build up a military that we systematically dismantled in 39 days. That is extraordinary success. Now, phase two. President Trump has laid out a series of red lines. That Iran can have no enriched uranium. Iran must hand over the enriched uranium they already have. Iran must stop funding terrorism. And they need to open the Strait of Hormuz.
Well, when does that happen? And particularly with the Strait of Hormuz. Right. And look, I mean, you represent a state that is basically the heart of our energy sector. And they're all affected by this. Even if they're domestic producers, we're all affected by this global market here. What are those executives in your state? What are they asking you, or at least asking from Congress and the government to do?
Listen, what I'm hearing from Texans is that we're seeing real success in Iran. And if you look right now, we're not today in a major shooting war with Iran. There are not active hostilities. What the president has done is he shifted to a different phase, which is the United States is blockading Iran in the Strait of Hormuz. That is imposing over $500 million of economic loss on Iran every single day. And here's the real kicker.
But no one else is getting through either. It's not just Iranian ships.
Look, if you look at the Iranian oil where it goes predominantly to China. So it's also imposing cost on China. But here's the enormous economic leverage. Iran is just a couple of days away from running out of oil storage capacity. When that happens, they will have no choice but to shut in their wells. When you shut in a well, inevitably what happens is water seeps in to the reserves, and when you restart production, it drops If they shut in their wells, Iran will see their production permanently drop anywhere from 500,000 to 800,000 barrels a day. That is massive economic leverage that the president is imposing on them, and it is very disproportionate. The United States is the world's leading producer of oil and gas, and so we're able to absorb this impact. Iran, I think America is much safer today with the Ayatollah no longer with us, with their military weekend, and my objective, I want to see this regime collapse. Now, I don't have a dog in the fight of who the next leader is, as long as it's not an Islamist who chants death to America and is actively murdering Americans, because that's what the current regime has been doing.
Well, Senator, I want to talk a little bit more about the effects that this is having on the U.S. economy, because you mentioned, you know, where the U.S. sits as a net oil producer has insulated us from what's going on in Asia, in Europe, but it hasn't completely shielded us from that. You think about average gas prices across the country, well above $4 a barrel, let alone what it is in California, where we are right now. I mean, those are costs that people need to pay. You think about filling up your car, you think about heating your home. So I wonder how the Republican Party plans on communicating that to voters ahead of a very consequential midterm elections where the cost of living just continues to go higher.
Well, look, I'll say in terms of gas prices, you go back a couple of years under Joe Biden, and gas prices were about $6 a gallon. President Trump and the Republicans in Congress came in, and we dropped it in half to about $3 a gallon. That was a massive savings. Now, anytime you have a military conflict in the Middle East, that's going to have an upward pressure on gas prices. So gas prices have risen to about $4.5 a gallon. So it's gone up about halfway from the distance it fell. That being said, this conflict will be over. It will be over in a matter of months. And when it is over, if we can have anything like a stable regime in Iran, that will have a long-term major downward pressure on gas prices. But more importantly, look, the Iranian regime is the world's leading state sponsor of terrorism. They've killed nearly 1,000 Americans. The president is acting to keep people safe. And by the way, you noted California. California people are paying $7 a gallon. That is not because of Iran. That is because Gavin Newsom and the Democrats tax and regulate the heck out of gas. They've made the decision that they want it to be really expensive to live in California, which is a big part of the reason so many people are leaving California.
I hear what you're saying, but the trajectory, of course, follows that of the national average. I do want to talk about the impact on jet fuel prices. We saw the demise of Spirit over the weekend, and I know that you were particularly vocal about being against a potential government bailout of that airline. And, you know, where we sit here on Monday with Spirit ceasing operations, do you still stand by that?
Listen, Spirit did not have to go under. And in fact, Spirit just 2 years ago had a plan to save themselves. They had a merger with JetBlue. They were the two ultra-low-cost carriers. They wanted to merge. JetBlue was ready to infuse $3.8 billion into Spirit. And Joe Biden and Elizabeth Warren and Pete Buttigieg went in and blocked the merger. And they killed Spirit Airlines. Spirit Airlines said at the time, if we don't merge, we will go bankrupt. We cannot survive unless we merge with JetBlue. And Biden and Warren and Buttigieg, they beat their chests, they defeated the merger, and as a result, 17,000 people this week lost their jobs. Not only that, consumer prices are going up.
But were you involved in any of the discussions potentially for a bailout? I mean, I know the Trump administration was considering. So what happened?
So I was actively involved. I think a government bailout was a terrible idea. I was very vocal saying we should not be bailing out corporations across the board. And the federal government doesn't know a damn thing about running a budget airline. And so I said that publicly and very vocally. Last week, I had dinner with Howard Lutnick, the Commerce Secretary. Howard is a good friend. He and I work together very closely.
Was he advocating for a bailout?
He was the leading advocate of the bailout. I will tell you, in the course of the dinner, we spent probably half the time at dinner with me making the case vigorously. This is a really bad idea. The analogy I drew, I said, look, the plan was $500 million in exchange for 90% of the shares in Spirit. I said, look, it'd be better if you took $500 million, put it in a pile on the floor, poured gasoline on it, lit it on fire.
That sounds expensive, too.
But there you'd at least get some heat. You could roast some marshmallows. You'd get something positive. My case was, if we pour it into the airline, we'll lose the money. And the federal government has zero expertise. Who thinks the federal government knows how to schedule flight attendants? Who thinks the federal government knows how to get a suitcase from Pittsburgh to Cleveland? I mean, just the mechanics of running an airline. There is no expertise in the federal government. I'm very glad the president made the right decision. We're not going down this road. It would have been a serious mistake if we had.
All right, Senator, we have to leave it there. Really appreciate your time. That is Senator Ted Cruz of Texas. A wide-ranging conversation and a lot of focus, of course, on what the future of aviation looks like in this country right now.
Yeah, and we should point out, I mean, obviously they were one of the lowest of the low-cost airlines, so there's a lot of concerns about what that potentially does in terms of upward pricing on airline tickets after you remove a big player like that. But again, obviously there were some negotiations going on behind closed doors. They weren't able to come to an agreement in time, and as you heard from the senator there, he wasn't actually on board with it.
No.
I mean, I would not light $500 million on fire. I think there's better use of that $500 million.
Absolutely. I wouldn't waste the gasoline at this point either, Romaine.
Absolutely. Here. A quick check on the markets there. 71.97 here, off the lows of the day, but well off the highs, but still holding right now on the broader markets, not far off of those record highs. And of course, with everything going on in the world, we're pleased to say that our next guest, he sits right at the intersection of macro policy, AI, enterprise tech. Gary Cohn is the former president of Goldman Sachs, former director of the U.S. National Economic Council, and he's been vice chair of computing giant IBM since 2021. He joins us right now. Gary, great to have you here.
Thanks for having me.
I don't even know where to start with you because you cover everything. But I actually do want to start first off because we haven't talked a lot about technology. There are a lot of disruptive forces going on from what's going on in the Middle East. And obviously we talk a lot about private capital. But AI, I think by anyone's measure, is going to be transformative.
Absolutely.
Whether that's going to be good or bad. You're at IBM, one of the biggest computing companies in the world. And I do want to point out, aren't you having a conference right now in Boston? But you're here in L.A., your IBM Think conference. This is your biggest conference. Why are you here?
Because you're here.
Oh, stop.
No, it's, look, we do have our largest conference of the year going on right now, our Think conference in Boston, as you said. Thousands and thousands of our clients there, rolling out a lot of our new technology, showcasing our new technology. But look, we're a global company. And a lot of our most important clients are here as well. So I made the decision to be here. The rest of the IBM senior leadership team is in Boston right now, and some of my team is actually going out tonight to get to Boston for tomorrow.
Well, that's what I'm curious about, too. I mean, obviously there was a very market decision to be here, and I do wonder about when we talk about this AI transformation, we talk a lot about it from technology, but this is becoming a finance story as well. I mean, you need capital to make good on the promise of what this is. Where does IBM actually fit right now into all of that?
Well, it's an interesting question. I'll leave the capital piece to the side.
Okay.
But when you talk about the AI architecture of the world today, because we are really redefining what AI architecture is. It's hybrid cloud, multi-cloud, all over the world. It still has on-premise computing, and it's data and data management. You know, we talk about AI all day long. But really, what is AI? It's a system that goes out and finds data and does the research and does the computation on the data. So at the end of the day, being able to manage the data, wherever your data is, and that's hard. Sometimes you have very organized data, sometimes you have very disorganized data, but being able to pull from that data real time to make sure you get the right answer. We're sitting in the middle of the data management business, as well as the on-premise computing, as well as the hybrid cloud structure. And we think those are three very important components of where the world's going.
Well, you think about your time at IBM, as Romaine mentioned, I mean, you joined in 2021, and you think back on the conversation around AI in 2021. I mean, ChatGPT wasn't really on the scene yet. It wasn't, so ubiquitous in modern life the way it is right now. And I just wonder, how the shape of those conversations have changed when you think about the last 5 years.
It's changed dramatically. So when I got to IBM, as you said, five and a half years ago, everyone in the world was convinced that the world was going to cloud. Everything was going to be in a cloud, and every model was going to be a SaaS model. You were going to basically pay for consumption. Well, guess what? It didn't really work out that way. A lot of things went to the cloud, and people found out the cloud has enormous amount of advantages, but on-premise computing and the mainframe still is a vital, important piece of equipment in the United States. Over 90% of financial transactions in the United States go through an IBM mainframe every day, every minute of the day. So this whole move that we're going to put everything in the cloud and the cloud is safe and the cloud is perfect, it's not worked out that way. Now we've got this hybrid architecture. So being in the cloud is part of it, being in hybrid cloud is part of it, being in the mainframe is part of it. And that's the way the world's evolving here. Then you bring in these large language models, which are a whole new set of technology. And you're right, when I got to IBM, The world of AI it's kind of interesting. Maybe we should look at it. You know, sometimes it hallucinates. Sometimes it gives you a great answer. And I think we all sat there and said, you know, probably get this worked out. Not crazy, but I'll tell you something now. We're at the exact same place with quantum computing. Today, we're in a world where quantum computing kind of works. Sometimes might not give you the right answer, but it's going to get better and better over time. So in my short period of IBM, I've seen this sort of ebb and flow of new technology come in, and even go back earlier in my career, you know, when we brought in new technology, you tend to see these ebbs and flows, and what you think at the beginning of the cycle is not what the end of the cycle is going to look like.
Well, to your point on quantum computing, I mean, we typically talk about it in the context of, you know, this is being presented as the next AI. That's how disruptive it's going to be. But do you think that, you know, corporate America, that, you know, America at large is prepared for that? Because you think about how disruptive AI has been, you could make the case that a lot of folks were not positioned for that.
So the world is not prepared for quantum, but the world was not prepared for AI 3 years ago. That's why I think the analogy is interesting. 3 years ago, people said, like, AI, I don't know if it'll ever affect me. I don't know if I'll ever use it. No one would have ever talked about how many LLMs are downloaded per day, per hour, per second. So quantum is in a very similar place. I think today people are saying, okay, interesting, not sure what it is, not sure what it does, not sure it will affect my life. But I said, we've seen this movie. Quantum is going to be real. It is going to affect people's lives. It may not affect people's lives in a real-time consumptive pattern the way people are using large language models today, but it will have dramatic effect in the healthcare system. It will have dramatic effect in the risk management system and pricing for banks. It will have portfolio optimization in some of the chemicals and science and physical science world. What can go on in the quantum model is just nothing short of extraordinary. But we're still getting there. I don't want anyone to think we're there today. We're evolving. We're going through error correction rate, and the machines get better and better every day. We've got about 85 systems out in the world today with over 300 clients using our quantum system. And it's, you know, it's people you would think. It's the Boeing Airlines. It's the JP Morgans. It's the Cleveland Clinic looking at human genomes. So all different parts of the ecosystem are in the quantum world, playing around with it, experimenting with it, getting really interesting data out of it.
There's a lot of upside to this, but as you know, as somebody obviously steeped in economics, there's still a lot of concern about the potential for job losses, certainly with AI and the potential productivity improvements that come with that. How do you balance that out? I mean, if you put your NEC hat back on here, I mean, how do you think about that and making sure that whatever benefits accrue to the society overall, that it is going to be a rising tide lifts everyone?
This is not a unique discussion. Every time we've gone through a seismic technological invention in the world or in the country, we have obsessed about job loss. And by the way, we will see job loss in jobs that are employing people today. But what we have seen historically, and I don't think this time will be different, what we see is massive productivity gains. When you see massive productivity gains, the economy grows. As the economy grows, we still need to put people to work in different types of jobs. So you can go back in history and look at all the technological advancements, and you'll read stories that are horrifying, saying all these people are going to lose their jobs. Oh my God, what's going to happen? And miraculously, the economy grows, people get jobs. Like today, we have a massive shortage of people in the trades. You know, if you're a person that can put down a cement floor and get it perfectly level for a data center, you're earning hundreds of thousands of dollars. If you're a person that can wire that data center, you're a person that can bring in the heating, ventilation, air conditioning, all air conditioning system. Those jobs are massive payers today, and there's a huge shortage of people. So some of the people that are doing tasks that they may not love to do because the AI machine is better at menial tasks, they can go from potentially doing an unsatisfactory job to a very satisfactory job in the trade.
When do you think we start to see those productivity improvements actually show up in the actual economic data? I mean, I think back to Kevin Warsh's confirmation hearings where he kind of made the case how some of those productivity improvements, at least in his view, could actually set the stage for actually cutting rates. Do you think we're at that inflection point? Because as you know, I mean, for decades, I mean, productivity effectively stalled in this country. Do you see this as being a true accelerator of that?
Look, AI is a true accelerator. You don't see the productivity gains day by day. You're going to have to measure them over quarter or month or year by year because like companies are adapting. You know, we're sort of going from the interesting science experiment of AI to the economic value. We're in that transition from science to economic value. We at IBM just to be honest, we have used ourselves as client zero, meaning all the AI tools that we're out selling to our clients, we have implemented them on ourselves. We have saved over $4.5 billion of expenses, and our headcount has not gone down. So we have been able to take people out of jobs they didn't like doing, move them into jobs with much higher value added to them. So take someone in an HR department. You know, historically, you're buying a house, you're renting an apartment, you need a reference letter. You need to know how long you've worked it, what your job title is, how much you've earned. You know, before AI, you would call up somebody, you would get them on the phone, you'd say, hey, this is so-and-so, I need you to send a letter to so-and-so. They would have to go pull your data out of your file and send out the letter, and you'd hope and pray they do that quickly. Now you go to what's an HR bot, you put in your information, you tell them to send to as many places as you want, and after you hit send, it's going back out.
Right.
The people doing that work, that's not highly satisfying work. We've taken people that were doing that work in HR, and now we have them out recruiting new talent to the firm. We have them out mentoring people to the firm. So we're getting much higher productivity out of that.
Right. I do want to bring this into the broader context of the economy, what we're talking about with AI, because certainly that has been a big benefit to the U.S. stock market. And there is the idea out there that you think about what's going on when it comes to energy prices right now, really impacting lower income consumers. And then you have the wealth effect of AI really translating into higher income consumers who are invested heavily in assets. And the general idea is that we're going to see this K-shaped economy basically be exacerbated, Gary. And I wonder, you know, where you fall on that sort of logic.
Well, look, we have a fairly massive wealth effect going on. You know, I look at the economy today as asset owners and non-asset owners. You know, if you own assets today, your assets probably appreciate. Whether it's a house, it's a car, it's a investable asset, most of these underlying assets are going up in value. Versus the other side of the K, which is a large predominance of our country, who's really suffering and really having a difficult time as their input costs, meaning their food costs, their energy costs, their insurance costs, their price of cars, price of used cars are all going up every day, and their wages are not keeping up with that. This is a problem. I mean, we can't sweep this under the rug. We have to understand that we've got a fundamental problem going on in the country. And look, it's starting to resonate with more and more people. I think that AI is part of the solution. AI can train people. AI can move people into higher paying jobs. Like I said, the jobs are out there. We just have to figure out how to train people.
All right, Gary, got to leave it there. So appreciate your time. I'm sure it's a busy conference for you. That is Gary Cohn. He is the vice chair of IBM. And happening right now, a conversation with Eldridge Industries CEO Todd Boehly, as well as the CEO of Mass Mutual, Roger Crandell, moderated by our very own Danny Berger. Let's listen in.
In terms of the actual kind of underlying product, I think when we talk about what happens in this period of financial market history 10, 20, 30 years from now, we're not going to be talking about what happened with a couple of private credit BDCs. We're going to be talking about the impact of technology and how it changed the whole economy.
That's an interesting point, that's not the lasting impact of this current environment. It's not the BDC outflows, it's technology. But Todd, if that is the case, is it something that could lead to significant widening of spreads? Do you think we've fully priced in the technological disruption that we're likely to get? Is there more pain to come in this market? Could we see a credit cycle?
Listen, I think we've been through a lot of cycles over a long period of time, and it's just natural to have cycles. And you have things that get built up, and then you have a cleansing, and then you have a picking up of the yard sale, and then things tighten again, and it's just you're riding a wave. And what you're really trying to do is to figure out, how do I eliminate the downside? How do I de-risk myself? Because ultimately we're all in the risk management business, and by using a capital structure, using covenants, using documentation, these are all things that you can use for your advantage. And in the broadly syndicated world, right, you've got a world where the documents, see what happens is the banks go from competing on pricing to competing on documents. And if you end up in a world where spreads are very tight and documents are getting very bad, right, that's a good time to be kind of exiting the scene and going looking for something else to be doing. So to me, one of the things that we're always focused on is how broad of a funnel do we have, so we don't get lost in a single product that goes through one of these cycles. Because if you look at defaults in the corporate bond market, right, they happen by industry. right? And as long as you avoid the industries that get sick at that moment in time, right, you're going to materially outperform. So if you go back and you look historically, right, it's all industry spikes or default rates spike within industry, right? Right now, the big debate is what's going to happen with the software business, right? And there's so many different types of software businesses, right? There's software businesses that are attached to infrastructure. That infrastructure is going to keep that business safe. There's software businesses that are attached to system of records, right? So ultimately, you really have to understand what's the risk profile of the underlying business, right? And in order to understand how do you feel about the credit. And ultimately, you know, I think one of the things that people are nervous about right now is that some of these software businesses aren't going to have real enterprise value and they're just melting ice cubes.
And to hear more of that conversation, type live go into your Bloomberg terminal. Now, our next guest, he helps lead the world's largest asset manager in liaising with commercial clients across the Americas.
Nice, I like that.
Yeah, that was, I had to think about how that one. Anyway, Joe DeVico, he is Senior Managing Director and Head of the Americas Client Business over at BlackRock, also a member of the firm's Global Executive Committee. I'm pleased to say he joins us now. Joe, great to see you.
It's nice to be here.
You think about BlackRock's clients, you have a lot of them, from institutional investors to financial advisors, family offices. The list goes on. You think about this specific moment in time. I'd love to hear the Venn diagram of, you know, what a financial advisor working with families is worried about versus, you know, a pension versus a large institutional investor.
Well, thanks for having me. I have the privilege of meeting with lots of clients. In fact, over the last 6 months, I've probably met with 500 clients across pensions, endowments, foundations, family offices, wealth clients. And I got to tell you, in my past 30 years, I've never heard so much uncertainty, whether it's the wars, the economy, the elections across the Americas. I heard you talking about AI just a few moments ago with Gary. There's just a lot of uncertainty, and it really comes back to clients are talking more and more about outcomes and whole portfolios, and they're trying to build portfolios that are much more resilient, much more durable through market cycles, through different market events. And they're also trying to personalize it for very specific outcomes for those clients. And what we're also hearing from like the taxable part of the portfolio is much more around tax management. And I think given BlackRock's scale and given our breadth of platform and investment solutions, all surrounded by great technology with our Aladdin platform, we have just an incredible opportunity to help clients like we've never been able to help them in the past, having much deeper conversations, ultimately to help them reach their financial goals. So this is an unprecedented time, but because of our scale, because of our platform, I think we're actually having unprecedented conversations.
It's really interesting to hear you say that the desire for outcome is very high right now. And certainly we've seen defined outcome as sort of a category of investing really emerge in a big way over the past few years. And, you know, I wonder what that looks like. You know, is that sort of a broad brushstroke sort of thing that you can apply to different types of clients, or how much do you need to individualize?
It's a great question. And obviously every client is a little bit different. But we have seen a dramatic shift from having individual solution conversations to whole portfolio conversations across asset classes, across wrappers like ETFs or mutual funds or SMAs, and across both public and private markets. And at the same time, we're seeing more and more clients trying to achieve a very specific outcome, whether it's more upside return, more income, possibly some capital preservation on the downside. And again, because of the different solutions that we have with like SpiderRock, which is an option overlay capability, with Aperio, which is a direct indexing capability, the recent acquisition of HPS and GIP, which is private markets, we're able to build very, very personalized portfolios for each one of those clients that are trying to achieve those different outcomes.
Well, you mentioned HPS, GIP. Yeah. I am curious. I mean, is this sort of a sign that maybe the ETF business has kind of matured?
Ooh.
Oh, good question. Not at all, actually.
Okay. Yeah.
Just the opposite. This is a sign that as clients are trying to build whole portfolios using all the available building blocks, and I think that goes back to even BlackRock's ethos, It is all about choice, whether it's an index product or an active ETF or a private market or an SMA. Our job isn't to advise clients on exactly what to use. Our job is to make sure that we're providing them the right choices for them to make the right decisions to make sure that they're able to hit the financial goals that they set out for their clients.
Well, I mean, I am curious about the onboarding of some of these companies and obviously the big expansion of private assets. And she kind of touched on this just a minute ago with regards to all that sort of being pumped through the wealth channel. We talk about the stress, whatever we saw in private credit this year, whether it was real stress or whether it was liquidity issues here. How do you manage that from a marketing perspective? Because you have a ton of products. They're all floating around out there. Are you confident in the way that they're being pitched to the end client is being done in a responsible way?
Yeah, we take that very seriously, Romaine. At the end of the day, we spend a lot of time on client education. So while we are a commercial organization, while we are a sales organization, at the end of the day, we also view ourselves as teachers. And I don't think there's a more noble profession than being a teacher. So whether it is an endowment, a foundation, a family office, a financial advisor here in California, our job is to teach. And at the end of the day, they ultimately are making the decisions on behalf of their clients.
All right, Joe, really great to get some time with you. Hope to have this conversation again soon. That is Joe DeVico. He is Senior Managing Director and Head of the Americas Client Business over at BlackRock, and as we mentioned, a member of the firm's Global Executive Committee. Meanwhile, let's take a quick check at these markets here because, you know, it is still a trading day, even though we're having so much fun in Los Angeles. You can see a little bit of a sell-off developing as we head into the closing bells, Romaine. The S&P 500, it's off by about 0.4%. But as we were talking about, that move in the context of what you're seeing in oil, in the context of what we're seeing in terms of the nosebleed levels of this index overall, it's not huge.
It's not huge at all. I do want to point out, you see the big move higher in yields here, and we talk about the volatility that we've seen in the bond market, in the yield space, as a lot of people try to parse, I guess, the economic consequences of what's been going on in the Middle East. Is there going to be a feed-through into the Fed at some point?
Right.
You know, we have a new Fed chair coming in.
I heard that, yeah.
You know, and he seems to be pretty intent on this idea that maybe the economy can withstand lower rates, but how do you do that at a time when you have Brent crude at $115? You have the average price of gasoline around this country right now above 4, and I don't know if you walked around Beverly Hills lately, but
a little bit.
Yeah, it's like 7 and rising around here.
Yeah, absolutely. And it was interesting to have that conversation both with Senator Ted Cruz when what we're seeing when it comes to gas prices and energy costs, but also with Gary Cohn, because you think about this K-shaped economy that we can't stop talking about, and it's really both sides of the K that are being forced further apart right here. When you think about the lower end, when it comes to those energy costs you can't avoid, and then you think about the impact that AI is having on our equity markets and what that has meant for the wealth effect.
Yeah, and it gets to this idea too of, but when does that start to show up into the economic data itself? We get this idea that, you know, we had a GDP report that seemed to suggest that everything is fine. We're going to have a jobs report that seems to suggest that everything's fine. And then when you get all into it here, you have a market that, despite being in the red right now, is still right around record highs.
Well, we're going to keep a close eye on that, but let's take a little bit of a detour right now because two prominent names in sports and business have joined forces to tackle one of the fastest growing health costs. GLP-1s. Wow. The former CEO of X, her name is Linda Yaccarino. She has teamed up with NFL legend Tom Brady to build eMed. I know, right? We're sitting right here. But let me just tell you what eMed is. It's a platform dedicated to helping employers manage costs associated with weight loss drugs. Linda serves as CEO. Tom is a co-owner and chief wellness officer. And I am just delighted that they're both sitting to my right. Thank you guys for joining us.
Thank you for having us. We really appreciate it.
So let's talk a little bit about how this all came together. And I'll start with both of you individually. And Linda, I'll start with you because you took the helm of eMed after spending 2 years as the CEO of X, formerly known as Twitter. And I would just love to hear about, you know, how that happened. What sort of translates from social media into, you know, running a telehealth company?
I thank you so much. It's a great question. And when I look back on my career, which will, I think, logically explain how I landed at eMed, you could probably mark it by 1 or 2 words, and it would be transformation, led by technology transformation and innovation, right? So throughout my career, whether I was at NBCU for so long, one of the outputs of that was launching Peacock to then go to Twitter and then X and creating the global town square. It made sense once I decided to leave X, what should I do next? And about 6 months prior to leaving X, I became chair of the board of eMed's direct-to-consumer business in England, the #1 female-focused GLP-1 business. And why it all came together is because what I learned and was so impacted by the profound nature of the power of these GLP-1 medications. And I certainly knew that access needed to happen for people, particularly in the United States. 60% of people get their benefits from their employer. Right. And only 1 in 5 employers cover GLP-1s right now. So once I was really thinking and considering what to do, tackling transformation in healthcare to give people access to these life-changing medications was an easy answer.
Well, let's talk about the Tom Brady of it all, because that certainly makes sense. You know, transforming X, now transforming eMed. But Tom, how did you get involved with eMed, and who called who?
Well, I've been involved in health and wellness for a long time. I think as an athlete, I realized that my body was my asset, so I had to take good care of it. And every day I had to put the right foods in my body. I had to have the right hydration, the right workouts, the right training in order for me to go out there and accomplish my job to the best of my ability. I started a health and wellness business in 2013 based around all the things that I knew and that I desired and I wanted other people to understand about how to keep their bodies and how they can stay active for a long period of time. But I also realized there's a lot of discipline that comes to making those daily decisions that allow you to be healthy. And a lot of times they couldn't take on this kind of Navy SEAL type training that I did as an athlete, because
not many can.
Yeah, not many can. And we spend hours in our day, and we have great resources to be able to do that. So what I realized with health and wellness in my post-retirement was a lot of times you have to meet people where they're at.
Yeah.
And you have to kickstart people's journey. And partnering with Linda and our friend Michael Ferrer, who founded the company, who's become a great friend of mine down in Miami, I think we can really help a lot of people. And like I said, to get people on the right program with the right individuals that's really tailored to them, they can start to begin to see some great health improvements in their life.
But I'm sure you have to sort of recognize the potential criticism that somebody like you, a world-class athlete, I don't think anyone's ever seen you out of shape. And yet, you know, you're pitching a GLP-1 alternative for some folks. And I understand the need, but why listen to Tom Brady? Why not listen to,
I think you should listen to your healthcare professionals who you should listen to. That's the most important thing. And I think for me, the ability to promote things that I really strongly believe in. And again, it's really about being proactive about your health. And one thing I realized, I was able to achieve great things in my life and my career because I was very proactive. I didn't wait to get injured. I didn't wait to get sick. I tried to stay ahead of those things. I never wanted to be injured. If I was injured, I missed the game. I couldn't do what I love to do. So now that I get to go out there, do what I love to do in this next part of my life, which is try to help other people, give them the best information possible so that they can make the right decision for themselves.
I think it's really important to point out the why Tom Brady of it all. In order for you, the importance is that you have to qualify to get on the eMed program. You have to take a blood test. You have to qualify through a variety of biomarkers that we check. And we want to make sure that you're one of those people that want to take control of your own health and take advantage of the unbelievable incremental nature of what these GLP-1 medications do. So tackle chronic diseases in their tracks. So it's not like other companies where you can just fill out a form and get a prescription. No, you stay with us.
So you're working with the employer. This is basically a flat fee model, more or less.
It can be, yes.
Is there any concern going forward as the cost of GLP-1 prescriptions goes down, oral medications come on, as that cost compresses, does that affect your fee model in any way?
No, it's actually so exciting because we're finally at a point where we have eMed delivers access to so many people that it's been out of reach because of the cost. So we have this health intervention of a lifetime moment. So there's a health solution for so many chronic diseases. And now we have a cost solution for employers because now it's affordable for them to cover it, and that's exactly where eMed sits at the intersection of that.
Are you going to do secondary markets? Like, I mean, didn't you have a partnership, I believe, with CVS? Or no?
Yes, we have a partnership with CVS, a strategic investor like Aon. So imagine these gold standard companies coming together, like-minded, woven together to break the cost curve and impact population health. What a good seat to be sitting in.
I do want to talk a little bit about how the introduction of GLP-1 pills has potentially changed anything. When you think about how willing employers are to cover some of these medications, it's only been a couple of months, but are you seeing any sort of impact there?
Yeah, we're seeing an expansion of the total addressable market. It's really interesting data, but unprecedented adoption of the oral pills from the early data that's coming out. And also important to note, one of the biggest adopters or segments are men, because they have hesitancy when it comes to injections, but they're much more open.
Tell me more.
Yeah, exactly.
Why is everyone so scared of a little needle prick?
Some of us, Tom,
Women braver, stronger.
That's true.
But so that's why there's unprecedented demand, and why we're kind of in a moment here where the opportunity to be able to talk, that's what we're doing here at Milken, talking to CEOs, talking to CFOs, that now breaking the cost curve is that time is here. We're able to do that.
I do want to go back to the Tom Brady of it all a little bit more, because Tom, you mentioned that obviously health and wellness is a huge personal thing of yours, and you mentioned that you founded your own companies in the past. We talked to a lot of former athletes on The Close actually about how they sort of approach. That's actually true. But how do you evaluate different business opportunities? How do you decide what to put your name to? And I mean, how many things are you saying no to at this point?
Quite a bit. Yeah, I get different opportunities based on what people are really looking for and how they want me to kind of play a role in their business. But I think I want to add a lot of value to what I'm doing. It's not just really, even with eMed, really being involved with Linda and our friend Michael, who's the founder of the company, and some of the decision making, how we're going after and how we're attacking this solution is what's very important. So to be involved in different ways, because I love learning. I love growing. As an athlete, I surrounded myself with incredible mentors over the course of my life that I was able to learn from. I was to take the things that they could teach me and then try to apply that going forward. Now I'm still kind of relatively young in my business career, but I feel like I have a lot of room for growth.
But you're doing well. Are you going to take this money, whatever you make off of eMed, and put that more into the Raiders?
We're working on the Raiders for sure. There's a lot to be improved, but that's football's I've always been my first love. I'm really, truly obsessed with that.
And you're going to stay tethered to the NFL in some way, whether as ownership or broadcasting or whatever.
Sure. Love football. I love team sports, and I love that it keeps everyone engaged, and I love that there's real outcomes every day. I think the purest thing about sports is that we can see how well we prepared. We can see what kind of work we put in, because there's a scoreboard on each end of the stadium. You get to see how you did. And there's something really finite about that we're all compelled to watch. And being involved in it for as long as I have, it's kind of, like I said, my first love. I want to be in it for the rest of my life.
Well, Tom, I really appreciate you being here. Linda as well. Good luck to both of you. Tom Brady, of course, NFL legend, now the co-owner of eMed, along with Linda Yaccarino, the CEO of eMed as well.
Such an interesting conversation, and I guess we do actually have to check on these markets again.
We do. We do this pretty frequently here on Bloomberg Television here, and we talk about this idea in all seriousness. We talk about the phenomenal growth that we've seen in the healthcare space, and obviously investors have really embraced this. And a big part of that is because some of the innovations, whether it's GLP-1s or some of the ancillary drugs, and GLP-1s have really gone from just being about cosmetics to really being about improvement in health.
Yeah, it's funny. I mean, you have this AI moment that's happening first in the tech industry and then everywhere else. GLP-1s really were the AI moment for the healthcare industry, because you saw a lot of opportunity there, but at the same time, you saw a lot of existing businesses being disrupted, especially when they first came on the scene in a big way. And the market continues to work through that when it comes to healthcare. Meanwhile, we're just an hour away from the close. What time is it in New York?
Well, it's 12 p.m. here in California, so that means it's 3 p.m., a little after 3 p.m. in New York. The market still closed at 4 p.m. Eastern time, despite the fact that we are 3 hours behind. Time does not change with us, Katie Greifeld. But it'll be interesting to see what happens this week, because we have obviously the concerns with what's going on in the Middle East, but we got a lot of earnings this week that could move the needle as well. We have a big jobs report as well coming up. And of course, everything that's going on in between, including a lot of deal making, or at least the talk of deal making here at the Milken Conference in Beverly Hills.
Yeah, absolutely. Have to imagine those conversations are happening behind us right now. But let's have this conversation too with Ali Dibadj. She is the CEO CEO over at Janus Henderson. It's a role he has held since joining the firm in June 2022. And as of December, the firm has approximately, or nearly rather, $500 billion in assets under management. Ali, it's great to see you.
Great to see you again. Great to see you, Ryan. Yeah.
Speaking of deals,
yes.
I believe this is your first broadcast interview since a bidding war broke out for Janus Henderson. You had Nelson Peltz's Tryon and General Catalyst on one side. You had Victory Capital over on the other side. Victory ultimately threw in the towel, but there was a lot of back and forth, and a lot of it was public. And to start on a personal level, I wonder how the past few months have been for you.
It feels good being wanted. Right? It's not always the case in asset management, but we've done a really great job at turning around the firm, and we're growing faster than any other asset management company that was out there. We continue to deliver for our clients in terms of investment performance across equities and fixed income and around the world. So I guess it felt pretty good being wanted. You didn't really know what path the board was going to decide for us to take, but we're very, very happy with where we are today.
And, I mean, you think about the setup coming into this. Tryon was already your biggest shareholder over at Janus Henderson going into this bidding war. They've been involved with the company for years at this point. But that being said, what does the future look like for Janus as a private company, now totally under the control of Tryon and General Catalyst?
Yeah, so we're really excited about what's going on. And, you know, the first thing is that we've done okay as a public company. To your point earlier, people want to talk to us, and we delivered for our clients. But we're really excited about the opportunities going forward. And really all it's about is being able to invest in our business on behalf and for our clients. And that's, I think, really important and interesting, whether it be in AI or in terms of hiring talent or other things. And that's also why the group of people that we have as partners, you mentioned Tryon and General Catalyst for sure. That's more on the AI play. We should talk about that if it's of interest.
It'll come up.
It'll come up. But other partners as well. So, for example, the Qatari Investment Authority is involved with us. So it gives us a really great sovereign wealth platform to work with. Mass Mutual, SHK in Asia, and a bunch of others who don't want to be named publicly. Typically, these people don't want to be named publicly, but allow us across the world to have pension plans and distribution partners to really allow us to invest in technology, in our people, in really delivering better investment quality for our clients in the end.
Well, let's talk about the AI stuff, because I mean, General Catalyst is basically an AI transformation type of firm here. So the partnership you have there, and I assume this is going to be, holding hands or locking arms, if you will, for the future.
Yes.
What does that end up looking like in terms of how that feeds into how the business changes from a tech perspective?
It's a great question, and it's actually a little bit of a question if you were fly on the wall, and a lot of the discussions that are going on inside these rooms that people are asking. It's like, okay, so how do you apply AI? And our view is very much that AI in the discussion set has been disproportionately about productivity and efficiency and cost cutting. And that's for sure part of the puzzle. But that's only, for us, the third out of three things that we really focus on. And I think we are the largest, I would argue, real, true AI transformation going on right now. General Catalyst and Tryon are our partners in really delivering on this. But a lot of the lessons of our AI transformation can be brought to other AI transformations. So to your question, the first thing that we did is really try to think about what we actually deliver for our clients. What is our core value add? And for us, that's investment performance. So, to your point, where do we apply AI to deliver better investment performance? Now, again, we do okay so far. Our assets under management that outperform benchmarks are in the 65 or 75% of time, outperforming the benchmarks over long periods of time and short periods of time. That's what we do. But how do we get it to 80? How do we get to 85 by using AI? So we're using AI now within our investment pools to figure out how do we digest information faster? How do we take advantage of discontinuities in the marketplace faster? How do we take the 350 investors that we have around the world who are meeting with clients, thousands of clients and thousands of companies on an annual basis, and mine that data much more? So the first part was just understanding the product and how to deliver that better.
But how do you differentiate yourself? I mean, you know this from your past. I mean, so you know technology, and you understand how fast technology changes. And this is probably faster than anything you probably saw earlier in your career. So my question is that what you're trying to do, my guess is half the people walking around Milk, half the asset managers here are also trying to do it. What becomes a differentiation, if at all?
Well, so I think I've already touched on one piece of differentiation, which is people are talking about just improving costs. Look, for us, we're taking the client lens. If your client sees you have better margins versus worse margins a little bit, they don't really care. But if you can give them better investment performance, that's really something that we're focused on, that's what we're doing. And we have the change management systems to do that because there's buy-in across the board. Now, the second element I was going to say is not just product, but then how do you deliver that to your clients? So we're actually reimagining how we deliver our product to our clients, getting the right product in the right client's hands with the right communication at the right time. And again, we can take a bunch of data that we're already putting into place and being able to target that. And that's what led partially to a little bit of our faster growth. And again, the third of the three is how you're more efficient, how you're more productive, et cetera. But for us, the key is that partnership with Trian and General Catalyst. We've done a lot of this stuff, like everybody else, to your point, Romain, internally. But what we find is what really is missing is that talent group that can be brought in and partner with us. We're the subject matter experts. They're the 4 deployed engineers, and particularly with a team within General Catalyst called Percepta to bring that forward and drive that forward. That's real differentiator.
Is your talent right now, are they happy with this deal?
Our talent internally, people are very energized about this because it unlocks us a lot of ways. You know, again, we did well as a public company. We certainly deliver for our clients, but this allows us to unlock a lot more investment in the business, including AI, and trying things to deliver better results for our clients.
And I am curious, I want to talk a little bit about your ETF business. As you know, I cover ETFs quite closely. And I mean, you have a CLO ETF that is just heads and shoulders above the competition when it comes to just the size of this fund. The ticker is JAAA there. And I wonder, you know, how you sort of extend that halo to the rest of your ETF business. And I mean, how did it become the monster that it is? Is that distribution? Is that model portfolio additions? I mean, how do you explain how this has become a $20, $30 billion product?
Yeah, well, you've been prescient on ETFs, and you've been covering for a very long time, so thank you for your participation there. Look, JAAA for sure has been a leader in this, but again, it's a little bit about having the right investment skill sets and marrying that with the client needs, again, at the right time. That business, to your point, has allowed us to develop halos in 2 different directions. One is other ETFs, particularly in the fixed income side, that we've developed, and now we have 5 that are above $1 billion in assets under management. Again, the leaders in their space, because people know us as being able to deliver not just investment performance, but the liquidity that they require within ETF form. And that's true for certainly wealth platforms, but really importantly for institutional platforms. Insurance companies, for example, are big clients of ours. So that's something that, again, haloing not just in JAAA, but in JBBB, which is a BBB CLO, or JA, which, as you'd imagine, an A CLO. We're not great at inventing new brands. JMBS, which is mortgage-backed securities, and other things that we're doing. So one was taking that playbook and applying to others where the client's needs are. And again, importantly, asking our clients what they need, was we were able to develop those products. The second area, though, is geographic expansion. So taking the products that we have in the U.S. and either developing kind of slightly tweaked products or taking the same products and bringing them outside the U.S. And we've done that with an acquisition that we brought on board about a year ago or so, a little bit more. And we're bringing our ETF franchise globally. And you'd be surprised, even though the U.S. has tax advantages, outside the U.S. there's still a liquidity need that people have. So in Europe, in Asia, where I was last week, in the Middle East, in Latin America, people are really starving for an ETF, easy-to-trade platform. And again, we want to be the providers of that. People don't know that we're the 3rd largest provider of active fixed income ETFs in the world. We want to continue to. You know that. You knew that. We want to continue to build that. Yeah. Well, there you go. We'll give you updates when we become 2nd and 1st, hopefully.
Perfect.
We hope so. Ali, really great to have you here.
Great to see you guys again.
Ali Dibadj, CEO over at Janus, Henderson, fresh off of, well,
on the other side of a bidding war, which you don't see a lot of those break out in asset management, so it was very exciting to see.
Yeah, and you just think about the phenomenal job that you've done at Janus even prior to this. It'll be interesting to see what the next leg looks like for this company. When we come back here from the Milken stage, a conversation on the health of the real estate sector with Don Mullen, the CEO of Pretium, right here on Bloomberg. Welcome back to the Milken Conference with our live coverage here of The Close. Romain Bostic alongside Katie Greifeld, and we're joined right now by a guest who sits at the center of one of the most politically charged debates in housing right now: institutional ownership of single-family homes. Don Mullen is the founder and CEO of Pretium, the largest institutional single-family homeowner in the U.S. Don, great to have you here on the program.
Thank you for having me. I appreciate it.
We love you. I'm not sure the president does. Of course, an executive order to potentially limit your business. I mean, you own a lot of homes. What is it? 90,000.
90,000.
And counting?
Yes, sir.
Does that get constrained if this executive order, which at least for right now is somewhat symbolic, becomes more reality?
Correct. I think that's important. The executive order is not enforceable, but the bill, the 21st Century Road to Housing Act, is the relevant piece of legislation. In it, there's a section called 901, which outlines provisions for institutional owners of single-family homes on a go-forward basis. It's at this moment under great debate between the House and the Senate. The House does not have that in there. One of the key attributes of that bill in 901 is a 7-year hold period. After 7 years, you have to sell the assets that you purchased. BTR in particular, build-to-rent programs would be sold, and that has dried up capital.
Yeah.
So we have a client, as an example, that I spoke to last night, who's been a big investor in build-to-rent, and he has his no stamp out. And every time a project comes on his desk now, no. So capital is drying up for home construction in the United States.
Yeah.
New home building has been declining steadily, in part because of this.
Yeah.
And if you look at what's in the media right now and in public advocacy, about 125 public housing authorities and advocacy groups, who are normally the people you look to represent prospective homeowners, to help people get access to housing, are opposed to Section 901. Now, we expect the Wall Street Journal to be opposed. We expect the American Enterprise Institute to be opposed.
Right.
But you don't expect housing advocacy groups in the state of Massachusetts, one of the most liberal states in America, to be opposed to Section 901.
Is that opposition, do you think, potentially enough to kill this legislation, or are you worried that this would actually pass?
I think the most important part of this legislation isn't 901. I would love to see 901 taken out.
Just taken out.
In its entirety.
Okay.
The rest of the bill is a critical part of reforming housing. It would speed up the ability for home builders to build houses, and time is money, as we all know. Speed up land development, speed up EPA approvals. Being in a position when we can reduce the cost of housing in America for the home builder to build. Home builders are building $400,000 houses in this country today. But Americans can't buy that kind of house.
But you've heard the criticism. I mean, some people would look at your business and say that's exacerbated some of the housing affordability
We own
issues.
such a small percent of the houses in America, and even such a small percent of the houses that are for rent. Forever, America has had almost 1/3 of the houses in the country rented.
Right.
Right? When we reached peak home ownership in the dreaded 07 period, we were high 60s. Right? So the challenge we confront today is not we're driving up home prices. In fact, for us as a firm, we haven't been buying homes off what's called the MLS for several years. We're a net seller of houses right now. What really is the problem today is home builders can't build houses that are affordable, in large part because it takes so long to develop the land. That takes capital. To go through all the housing lot, the opportunity to zone it properly. With all of that going on, taking as long as it does, home prices are $400,000 to $450,000. Americans at today's interest rates can really afford a $300,000 house.
Well, to follow up on Romain's point here, I mean, it's a soundbite that works. You know, this idea that the administration has is they're not alone in that, and in putting it out there that, you know, institutional investors, they're why you're paying higher prices because, you know, they're buying up all the housing stock. So, I mean, just as an industry, as a leader in this industry, how do you combat that sort of narrative, which is pretty bipartisan?
Well, I would say it's bipartisan almost in the wings. And what I mean by that, it's a minority in each party. If you look, the House is pushing back very hard on this. As I said, there's a lot of liberal advocacy groups that are opposed to this. And the math just comes out and shows you that we don't own a lot of houses in America. But let me bring up another point relevant to that. There's always been Americans renting houses. When I grew up, my dad was an elevator repairman. And we couldn't afford to buy a house. And we lived in an apartment, then a 2-family house, and then we rented a house. Eventually, we were able to buy a small Cape Cod in River Edge, New Jersey. If we are in a position that we're going to penalize people who want to rent houses in good neighborhoods, we're actually, in an effort to make housing more accessible, penalizing people who have 600 FICO scores and saying your kids can't go to a good school. You can't live in a low crime rate area. we're actually creating a proposal that hurts Americans who are middle class and lower middle class. And so I believe that we should try to find the right balance between advocating for home ownership, which we are in favor of, as well as making sure we have rental stock in good communities that allow children to go to good schools. And if you look, there's a great study by Raj Jetty at Harvard, who's it's part of the Opportunity Institute there, and it speaks to the fact that a child who grows up in a community that's more owned than rented makes $100,000 more in their lifetime, has a substantive decline of the risk of incarceration, right? We need to make more homes available in ownership communities for rent, not less.
Right. Well, in the meantime, I do wonder, whether you anticipate that you will see more families move to the rental market. The fact that you do have mortgage rates that are still quite high in this country, for a lot of folks doing the monthly payment math, it makes more sense to rent when you just look at sort of the dollars and cents of it all.
40% cheaper to rent the same house than buy it. Simple as that. And so for families who have a FICO score that doesn't qualify or doesn't have the down payment, this product allows them to live in communities they otherwise couldn't access. And I think that's critical when we think of the opportunity for people to either break intergenerational poverty, and we do Section 8 vouchers in good communities, or for families who just are on the process of saving to get their kid into a good school while they save.
Well, on the Section 8 business, I mean, because that's relatively new.
For us. But
for you, but are you a believer in that, or is that more sort of, maybe creating a little bit more of a political sheen to what's going on right now?
Oh, we definitely didn't do it for a political sheen. I mean, one of the advantages you have if you're our size is the efficiency that we can run an operation. So we can use a Section 8 voucher, give investors very good returns, and provide great quality housing for people because of the scale that we have.
With regards to those returns, I do want to ask you just about the interest rate environment. Obviously, your business, these types of businesses rely a lot on securitization. How has that elevated interest rate environment affected you?
Well, I mean, the cost of debt capital is very important in our business, just as it is for an American homeowner, and it makes it harder in this environment to find investments that are very attractive for our LPs, and our LPs span from U.S. state pension plans to private and public pension plans, insurance companies. But there is some opportunity to continue to find assets that generate the returns they need, but it's certainly harder.
And before I let you go, I do want to return to the point that you were making, just that, it needs to be less expensive for home builders to actually build in this country. There's a whole lot of reasons why that isn't the case, but are you at all optimistic that that is going to change in the next few years?
I believe this bill, if we take Section 901 out, will be be viewed as a great moment for America to be in a position to clear regulatory hurdles, make the process faster, bring more capital into the space, because capital will drive home construction, and make it so that we can have the opportunity to reduce the cost of building new houses.
All right, Don, really appreciate your time.
Thank you for your time.
That is Don Mullen. He is the CEO of Pretium. Really interesting conversation when it comes to the housing market in this country, and of course tying together the political aspect of it all, since it's a hot button topic in Washington as well.
Absolutely, and we've talked a lot about this, particularly over the last year and a half, that intersection between what's going on in Washington and what's going on in Wall Street proverbially, and just how all of these asset managers and investors have had to navigate what's going on down in Washington rather than just their main business.
Absolutely. Well, still ahead on our special programming, we're going to continue our live coverage from Milken with Robin Vince. He is the CEO of BNY, as well as Stracke. He is the president of PIMCO. All that and more coming up on The Close on Bloomberg.
And welcome back to Bloomberg's extended special coverage of The Close at the Milken Institute Global Conference in Los Angeles. We want to talk about BNY. It's the world's largest custody bank, entrusted with safeguarding and moving more than $52 trillion in assets. Now its chairman and CEO is betting that AI, digital assets, and a complete reimagining of the firm's platform can write the next chapter for an institution that's been at the center of financial markets for 242 years. Robin Vince joins us now. Great to have you here, Robin.
Great to be with you, Romain, Katie.
We've talked before about the tech transformation of this business, and it seems to be a hallmark of what you've been trying to do ever since you took over. It's already starting to show up in the numbers, in your bottom line, in the top line as well. When you talk about the further integration of AI and some of these technological tools, what is the primary result that you want to get out of it?
Sure. Well, first of all, it's great to be with you here at the Milken Institute. The conference is a great conference, really contributing to the dialogue from all around the world, and what's such an important time to be doing all of that. So look, the story of BNY has been of a company that had just fantastic assets, great client franchise, great businesses, and great people. And we determined that we could just operate them differently and reimagine them to some extent. And so it hasn't only been about AI, it's also been about how we've organized ourselves internally, culture-driven, client-focused, bringing a new commercial model to actually make the business differently. But now we've got the great gift of doing it in the age of AI, where we've got the superpower to be able to bring in to the company to turbocharge what it is that we've been doing. And you're right, we've been making great progress along the way. And now with the gift of AI, we should be able to make more. So what are we doing? So we view AI as having three key opportunities for our firm. First is we can actually take AI to make the products that we make for our clients, the platforms that we have, our technology and services, better for them. The second thing is to actually help us to run the place better, to be able to have more efficiency, to be able to create capacity in one place so that we can then take people's time, which is one of our most valuable assets, to actually deploy into doing new and other things. And then the third one is there are actually businesses that previously just weren't super economical to actually deliver to our clients. And now we have the opportunity to go out and with AI as a benefit to be able to bring down the cost of delivery of those things a little bit, to be able to explore offering those to clients as well. So we're excited about all three vectors.
With regard to your investment that you're making in there, we talk a lot on this program about all the money the hyperscalers are spending and just large corporations overall. I think at least publicly you've talked about a $4 billion investment specifically in some of this technology. Does that need to grow more given how fast this technology is changing?
So we spend about $4 billion a year on technology. And so for our company, we actually think that's a tremendous amount of spend. And what I think is going to evolve is more the composition of the spend. We used to spend it in a certain way. We used to spend it on vendors. We used to spend it on our own technology. And what essentially is happening is now there are more things that we can do for ourselves. And the cost of actually delivering a solution in the company is going to come down over time. So the way I think about it is $4 billion is going to be able to do more for us over time than it has in the past. And that's why the timing for us just happens to be very fortuitous, because we've been reimagining the company. We've been organizing differently. We've been organizing ourselves more along platform lines. And so now the opportunity to bring AI to actually turbocharge the software in terms of the products and services, it's actually great timing for us. Now, look, if you step back from the overall story in the United States, you referenced the $750 billion or so of CapEx, and that really is part of what's happening in the American economy right now. We're seeing all of this money going into CapEx. Remember, it's full stack, so it's everything from real estate, power, chips, everything across the AI spectrum. And that's creating essentially an investment in manufacturing and in creation and all sorts of engineering jobs in the US. And then the benefit of that investment is going to accrue to all of us as we get to be able to deploy AI into our respective businesses. So it's actually a double boost to the economy, one on the manufacturing and infrastructure side, and then what will follow will be a further investment into productivity and capacity creation in American business.
Well, when it comes specifically to the investment that you're making in your business in regards to AI, how has that changed, if at all, the complexion of your workforce? Because, you know, one of the big existential fears with AI is that, to put it bluntly, it's going to take all of our jobs.
So, look, it's very hard to look out a super long distance in the future. Look, the speed of AI, everything is moving so quickly. It was hard to imagine that we'd be where we are today if you just go back to the moment of AI sort of popular origin, I'll call it, which is the ChatGPT moment at the end of 2022. So things are moving very quickly. The power of the models is growing very significantly. And so it's very hard to put a pin in exactly where we'll be 3 or 5 or 10 years from now. But the way that we think about it is AI is a capacity creator. It allows us to be able to do more things with the people and the platforms and the client assets that we already have. And which company wouldn't like to be able to do more without having to expand your expense base massively? And so we view ourselves in that position. We're not AI doom mongers. We're not all about driving efficiency. We're driving capacity so that we can essentially do more and we can make our people more productive. And we think that's a much more practical way to go about it. So as a result, guess what? In the past 2 years, this year included, past 2 years, the number of analysts and interns that we've been bringing in from college is actually up versus where it was a couple of years before, because they're coming in with AI skills, they're bringing energy, they're bringing creativity, and so to be able to have them join the workforce and bring that with them, that just allows us to do more and go faster.
Right. Well, outside of AI, I do also want to talk about some recent developments for BNY. You know, you think about the introduction of Trump accounts. I know that BNY was selected as one of the financial agents there. And I wonder, you know, how that came together. You know, is that something that you had to lobby for, or just walk us through that process?
Sure. Well, let's just start with the origin story. This has been a real bipartisan effort in Congress and with people, Brad Gerstner, Michael Dell, really the original ideas of bringing this whole thing to life. And then what the administration has done, and I applaud this piece of public policy, and I really applaud the leadership of the Department of Treasury and the administration in really getting this into the bill and then actually bringing it to fruition. And so what is it now? It's a pathway for every child in America to be able to have a stake in the country. And so, yes, the $1,000 grant, but the matching is just as important that companies like ours, and we are doing matching for every child of one of our employees born who applies for the government grant, can also get matching from us. And then you have philanthropists like Michael and Susan Dell coming into the mix and all across the country. And so what collectively we're doing is we're building a pathway for kids to be able to have a nest egg, an amount of money which in 20, 30, 40 years from now is going to be very meaningful for them and is going to be able to have them be part of the American dream. What better place to be talking about it than here at the Milken Institute? Because enabling people to participate in the American dream is an incredibly important part of what this country should be all about.
Well, let's use that as a segue. I do want to talk a little bit about your wealth business and just some of the rebrand that we've seen with regards to Pershing and this sort of wealth solutions moniker that is now over that. Is this sort of an indication that you are pushing deeper into the wealth management space?
So we have two wealth businesses at BNY. We have our classic wealth management business, which is $350 billion assets under management and custody for our clients. And then we also have a wealth solutions business, which is known as Pershing. That's the brand that it's operated under for a long time. And that business is $3 trillion worth of wealth assets, which we provide a whole variety of different services to our clients. And so if you're a registered investment advisor or if you're a broker-dealer, our ability to help you with access to product, asset management product, including now alternative product, private market product, and then the software and the services and the tools that you need to be able to run your business. And so that's what the Pershing classic business actually is. And both businesses are exciting to us, and obviously it's an important and growing market.
Well, is this going to transform BNY? I mean, I know at the heart you are still a custody bank, and that is the lion's share of what you do. But are you going to get to a point where you're going to have to start evaluating the performance of your business based on investment returns as that wealth business grows?
Well, we have already started to think about it differently. Our custody business, you know, we are the world's largest custodian. We've been in that business for a long time. We're a trust bank. Those are all great attributes, great brands. We're about infrastructure. We're about enabling infrastructure, the transformation into the world of digital assets over time, providing the import-export of financial rails, both here in the U.S. but also elsewhere. Those are core businesses for us. But increasingly, now about 2/3 of our pre-tax income comes from other businesses that wouldn't traditionally be thought of as trust bank businesses. So if a trust bank business is custody, wealth management, and asset management, then our platforms businesses,
clearing and the services we provide globally in clearing, including U.S. Treasuries, collateral management, our Pershing business that we just talked about. We're the world's largest corporate trustee,
right.
Our depository receipts business. We make $3 trillion of payments every day in our payments platform. So you look across those businesses, and those businesses, which in this prior quarter we had a 50% margin on, and those things represent collectively about 2/3 of the pre-tax income of the company these days. So yes, BNY has been transforming, and now AI should be helping us over time to turbocharge that transformation.
Well, when it comes to digital assets specifically and the work that you're doing there, from different angles, I do wonder, is that about bringing new clients into BNY, or, is that in service of demands from your existing clients? I have to imagine it's a combination of both, but what broadly are you seeing?
Well, Katie, you're exactly right. It is both. And so we see ourselves as a little bit of a bridge between these two worlds. We've invested in digital assets, and we have a lot of clients who are very interested in being able to use us and connect to us in the digital asset sphere specifically, new digital asset economy clients, but they also need some of our traditional services. So they want to be able to have custody. If you're a stablecoin operator, we provide services to stablecoin operators. Guess what? They need custody for their treasuries. They need to be able to have asset management for their treasuries. They may need fund administration services. They may need payment services on ramps and off ramps. So we provide that bridge. And then if you're a traditional client and you want to participate in digital assets, then maybe you need tokenization help. Maybe you run a money market fund and you want to be able to have a new share class for the digital asset version of your money market fund. Or maybe, as we just announced with Morgan Stanley a couple of weeks ago, with supporting their ETF and their Bitcoin aspirations for an ETF. And so, again, it can be the traditional clients looking to move some of their business or dip their toe in the water of the digital asset world, and also vice versa. So the coming together of both is quite an exciting place to be.
Robyn, really appreciate it.
It's good to be with you both. Thank you.
Robin Vince, the CEO of BNY. Meanwhile, it's just a little more than 15 minutes until we get to the closing bells in New York. We should point out stocks off session lows, but not far, but off those session highs as well, Katie. And we talk about a market that's still trying to digest a lot of the geopolitical issues that have been battering it around.
Yeah, but this market has been happy to focus instead on what's coming through when it comes to the earnings slate. And certainly we have some earnings coming up after the bell as well. You think about Palantir, you think about onsemi, certainly a lot to chew on there.
Yeah, we're going to have a full breakdown of that for you after the bell. But when we come back here at the Milken conference, we're going to speak with PIMCO President Christian Stracke, get a little bit more of an international perspective. You don't want to miss that conversation. That's coming up next here on The Close, right here on Bloomberg. Welcome back to a special edition of The Close here on Bloomberg from the Milken Institute Global Conference in Beverly Hills. We continue our conversations with the biggest leaders in the world of business and finance. And our next guest, he's spent almost 3 decades dissecting the credit markets, from Latin American sovereign debt over at Deutsche Bank to building out PIMCO's global credit research operation. Now, he runs the firm's international business from London, and he joins us here in California. Christian Stracke, president of PIMCO, joins us here. Great to see you, Christian.
Good to see you, Romain.
Let's start off with the international business and the build-out that we've seen PIMCO do there. And I am curious as to what clients outside of the U.S. are actually looking for when it comes to investment opportunities. And does that differ much from what you're seeing here in the United States?
Yeah. Well, first of all, you're right. We've been building out that business, and it's been quite successful. The high-quality fixed income notion of PIMCO really resonates around the world, as it does in the U.S. It resonates around the world. Same kind of questions. There's a demand for income. There's a demand for something that different in the portfolio. As equities do so well, how do you diversify away from equities? So in some ways, it's very similar. Now, also what we see is an ask for something other than just the U.S. What else is there? Global fixed income, emerging markets, also alternatives in outside of the United States jurisdictions is another area, real estate, infrastructure, et cetera. So there really is this ask of what more can we do than the U.S., especially because as U.S. equities do better and better and better, it just means that your portfolio is more and more exposed to the U.S., which last year was a bit of an issue. If you're not denominated in dollars. If your home currency is not dollars, it's euros, it's yen, it's something else.
Yeah.
You saw the dollar depreciate as much as it was a rude awakening. And so now there's a lot more of an ask for how do we diversify away from the U.S.
When we talk about that geographic diversification, though, is that a long-term structural shift, or do you think that maybe the pendulum swings back, assuming the political situation here evens out?
Well, I mean, we're not calling for the end of the dollar or anything like that. No, it's not that. But no, there is a structural. I mean, people are looking at the fracturing of geopolitics, and that speaks to the need for diversification. And so, yes, this probably is a structural long-term trend that we'll see. Now, that said, we see in instances like in March with the outbreak of the conflict in the Middle East, then the dollar does do well. So it isn't a one-way train, but yes, we do think that over time you're going to see continued requests for diversification of portfolios.
I want to talk a little bit about private credit because, I mean, you think about the conversations that are being had stateside and especially at this conference, there's a lot of concern out there. But do those same concerns exist when you take a look at Europe and just the globe in general?
They do. They do. And in some ways, even more, because if you're an investor in Hong Kong and you're so far removed from what's going on in the U.S. and you start to see these headlines, you start to see underperformance, you start to see defaults, you hear about fraud, then you overreact even more than many in the United States do. So everything that you see in the United States in terms of investor reactions is actually magnified outside of the U.S. for those investors who invested in the U.S. And then, of course, we've seen instances this year of asset-based finance opportunities in London get into trouble with fraud and real questions there. So all of these questions are very much relevant and very much alive with international investors.
That's fascinating. And I do wonder, I mean, you think about, again, one of the big concerns when it comes to U.S. markets is that what we're seeing when it comes to retail investors, the big redemption requests that this past quarter has seen, that might trickle into the institutional set as well, where demand is still strong, it looks like. I mean, does that also apply to international investors as well, or what does the breakdown between retail and the professional set look like?
It's a good one. I mean, international institutional investors are very much like U.S. ones, where this is a long-term position for them, and they're much more patient about what's going on in the headlines around private credit. They've underwritten for there to be a cycle over time. They know that there's going to be defaults over time, and sure enough, here's where we are. So, we're seeing a lot more patience with those international investors. That said, they're looking more and more, like everyone else is, for what else can I do in private credit rather than monoline direct lending to levered companies owned by private equity sponsors. What else is out there? And so this rich vein of asset-based finance, residential mortgages, consumer loans, aviation finance, data center, construction, development loans, all of this is very much alive outside of the U.S. as well. And the demand for something diversifying away from sort of the core direct lending opportunity is very much alive internationally.
Is most of the demand, though, pretty much in that AI tech space, or is it broader than that?
No, it's much broader than that. Sure, I mean, we're looking at consumer loans in Singapore, we're looking at residential mortgages in Australia, we're looking at bridge lending in the UK. I mean, it's really spreading. What we see in the United States, what really started maybe 6, 7, 8 years ago in the United States, of banks looking for partners, exiting some areas, looking for partners in some areas, selling loans to the PIMCOs of the world. We're seeing that really spread into Europe and into Asia now, and that's a great diversifier away from what can sometimes be somewhat crowded in the United States.
Is the sort of investor class in that part of the world, though, and the difference between what you have here in the U.S., is there a higher is there a lower risk tolerance over there?
There is a lower tolerance for defaults. So, now, everybody has a low tolerance for defaults, as do we at PIMCO. But certainly, again, when you are outside and you're not used to defaults, because in Europe the default rate is extremely low on bank loans and things like that. So there is that. So, look, but that's what PIMCO tries to do, is provide this up in quality source of diversified private credit income, not reaching for the yieldiest thing that might deliver the best returns if everything works out, but making sure that you've got downside protection. So there is that much more demand for what is the downside protection? Is it real? How do you know it's real? What's your track record that shows that you're actually delivering that downside protection? So yeah, it's a great point, and it's one that we really focus on.
I do want to talk a little bit about inflation, obviously a hot topic when it comes to the U.S., but, you know, a conversation we've been having today is you think about some of the energy ripple effects from what's going on in the Middle East. The U.S. relatively insulated when you think about what's going on in Europe, when you think about what's going on in Asia. How is that filtering through into your world when you think about inflation?
Sure. So, I mean, we are very much focusing on the stress tests and the downside scenario where what if this continues for a lot longer than we've expected? What if there are second order effects onto broader inflation? That's not our base case, but it certainly is possible. And if you look at the Bank of England last week, they actually ran scenario analysis a little bit like this. So got to focus on what is that downside scenario. And as you say, the European economy, the Asian economies are more exposed to this energy price shock than the U.S. And already the European economy was weaker and didn't have all of the capex cycle that the U.S. has, so it's less resilient to begin with. And so we're very much focused on, it wouldn't take much for there to be a more serious outcome on the economy in Europe and to a lesser extent in Asia. And so then feeding those into our scenario analysis, not just in private credit, but across everything that we do in across fixed income in general.
Absolutely. And when you think about, you know, the work that you're doing across fixed income in general, I mean, where is the haven in this moment? Because when you think about the U.S. Treasury market, especially what's going on at the long end, a lot of investors have said that's not necessarily as reliable as it has been to sort of buffer those downside shocks.
Yeah, well, we still think through the cycle and through all of this, the haven is high quality fixed income, and that is in the U.S. and that's international. Now, the question is, well, what's high quality and where, you know, and how much high quality do you want? But ultimately, yes, could there be more volatility in interest rate markets? Of course there can. But at some point, rates go high enough that it starts to really slow the economy and slow equity markets. And that sort of, in a way, stabilizes itself. So our view is, yes, there could be more volatility, but over time, we expect that fixed income will continue to deliver pretty interesting risk-adjusted returns and as a good diversifier to equity exposures.
Just real quickly, and no concerns about the potential divergence in central bank rates, the idea that overseas you're potentially going to see a rise?
Well, it certainly is a possibility, and you know, the market is calling for several cuts in Europe. We think there would be probably fewer than what the market is pricing in, but there's a good chance that Europe will hike 1 or 2 times. The Bank of England, the market is pricing in 2.5 hikes there. I mean, you know, the hiking cycle is going to start globally, and there will be that divergence. But it's showing up in rate differentials. It's showing up in currency differentials as well.
All right, Christian, got to leave it there. Great to get some time with you. That is Christian Stracke. He is PIMCO president. Now, coming up next, it's the closing bells. And up next hour, I'm pleased to say we have Dan Simkowitz of Morgan Stanley, as well as Ron O'Hanley of State Street. And then we're going to close things out with Ann Walsh of Guggenheim Partners. Don't go anywhere. This is The Close, live at Milken, right here on Bloomberg.
Welcome back to a special edition of The Close, live from the Milken Conference in Beverly Hills, California. I'm Romaine Bostick.
And I'm Katie Greifeld. And of course, we're counting down to the closing bells here in the U.S. And we know that we've seen a little bit of a sell-off develop today, Romaine, but you think about the levels that we're coming off of, not too much here to talk about, but the S&P 500 looks like we're going to finish about 0.4% lower.
Yeah, holding still around 7,200, not far off the record high. All of the major indices here in the U.S. in the red, mainly fractionally, with the exception of the Dow Jones Industrial Average. And I do want to point out, Katie Greifeld, Dow Transports, down 5%.
Thank you. I was wondering, that is a lot of percent, at least relative to the S&P 500. We were wondering when we were going to see sort of the oil narrative reinsert itself in the equity market. Perhaps that's what we started to see today, but certainly we're going to continue to follow that story all week. But let's turn now to our next guest, who has worked on Wall Street for decades. Dan Simkowitz. He joined Morgan Stanley back in 1990, doing business in New York, Tokyo, and Hong Kong. Now, he was on the front lines with the firm's assignments with the U.S. government during the financial crisis, and Dan is now the co-president of the entire bank, and he joins us right here in Milken. Dan, it's great to see you.
Nice to be here, Katie. Romaine, thank you very much.
I do want to start with deal making because you think about the first quarter of 2026, it was the best start to a year ever for deal making, a global tally of about $1.3 trillion. But we know that the world changed at the end of February, at the start of March. So I wonder where you're sitting now, of course, in May. How do your expectations for how 2026 is going to play out? Where do they stand relative to where they were at the beginning of January?
Yeah, I think backlogs are still very strong. And you saw, even in March, a series of M&A announcements. So I think the backdrop around deal making is still pretty solid. I think in that context, corporate boardrooms didn't do a lot of M&A in 22, 23, 24. So there's a pent-up demand around pursuing strategic action. There's a rationale to do that. AI, spend, the focus on scale. You've got a regulatory environment that's pretty conducive to mergers. And then you've got the markets, and you guys were just talking about it. Mm-hmm. You have credit markets that are still functioning exceptionally well. Investment grade, non-investment grade, and with liquidity. And then the last thing is the S&P is at a pretty good price in that context. Now, all of that is balanced against geopolitics and some uncertainty around the disruptive and transformative part of AI. But the sort of backdrop over the balance of 26, and we would argue into 27, around the resurgence in M&A is still there.
And it's interesting, you bring up AI, and that's the other big disruptive force that I wanted to talk about because, you know, we've had a lot of conversations here and over the past few weeks about how that's playing out in private credit, sort of the big overarching concern that software businesses that looked like sure bets in 2021, 2022, maybe not so sure now. So outside of private credit, how is that impacting the IPO pipeline and the deal-making trajectory?
Yeah, and I can get back to AI finance, which has been the big activity for us in the last 8 weeks or so, and throughout last year. You know, software equities are down. Some of the concerns around AI disruption is there. The IPO pipeline in software is relatively modest. I think over time you'll see consolidation and winners and losers being picked around the software industry. It's not going away. And so firms will adapt, and that will create capital raising opportunities, but it will also create some level of either consolidation or changes of ownership. But, you know, it's a relatively small part of the of the sort of wallet for deal making, as you said. So we haven't seen it really play through in any meaningful economic way for deal makers.
Is there a certain sector that you look at right now as maybe potentially being the primary driver of M&A activity, or is it going to be a little bit more dispersed?
I think it's quite broad-based. Yeah. I think where we look at our pipeline and where we deploy resources, I think you've got technology away from the software sector where there's still a lot of economies of scale and people trying to buy and merge and create synergies in that business. Healthcare is still extremely active. Industrial companies trying to understand how the world's supply chains work, how the energy flow of capital works. But even on consumer, we did a very large deal or announced where McCormick and Unilever put their businesses together. And so I think it's quite broad-based. And then you do have that regulatory overlay, which is pretty broad-based in terms of a willingness to allow some consolidation. And I would add, financial services is in that category as well. So it's quite broad-based, and it's broad-based not just in the U.S. It's global M&A is up as well.
Are you finding that clients are doing these deals because they want to or because they have to?
I would say the majority are doing them because they want to. I think the buyers are looking for ways to grow their business, to take advantage of their relative competitive advantage, find opportunities for growth. And then I think private equity is a two-way market, right? They both have enormous dry powder, but they also have portfolios that are starting to age. And so you see an inducement there to act. But there's very little, I would say, distressed M&A in the marketplace this year and probably for the rest of this year.
Let's go back to AI financing, something that you mentioned Morgan Stanley is doing a lot of right now. Talk to us about the momentum, because, that's been the story for a while now when you think about the markets overall. I mean, you're still seeing that continued demand, though.
Yeah, there's very strong demand, and I think this is a great U.S. story, right? So you have all this AI deployment. The big LLMs are here. The big hyperscalers are here. The CapEx is very large. It's all being raised, in essence, in the capital markets one way or another, or the cash flows from these very large companies. And we're seeing just real large, diversified pools of capital be deployed. So you're seeing that in the equity raises that some of these companies are doing, both publicly and privately, strategic and financial investors. But in the credit markets, we're doing big unsecured bond deals for the hyperscalers, like a Meta or a Google or an Amazon. We're seeing delayed draw term loans for a company like CoreWeave, where we did it with the private credit market, but then they're out now with a chip-based, GPU-based financing that's going to the public term loan market. So real diversification in the credit markets, supplying some of that capital. And then you've got these great balance sheets, NVIDIA, Alphabet, Meta, Amazon, Microsoft as well, providing some real support to what we think is a transformative technology that needs to get financed. And I think Jensen is speaking later today, but he talks about, compute equals intelligence, and then intelligence equals revenue. We're seeing that in the real world around companies deploying and revenue ramps for some of these infrastructure companies.
All right, Dan, I have to leave it there. Really appreciate you taking time
Thank you so
for
much.
us. We'll let you get back to it. Dan Simkowitz, co-president of Morgan Stanley. Now, we do have some earnings crossing the Bloomberg terminal in just the past few minutes, including from Palantir. Speaking of AI here, basically a beat and a raise quarter for the company. Revenue in the most recent quarter did come in above estimates. EPS at 33 cents. The street was looking for 28 cents. And your forecast for the year, the company nudging up its full-year revenue guidance to 7.65 to 7.66 billion, up from about 7.1 to 7.2 billion dollars. The company also saying that on the bottom line number, it does see full-year adjusted operating profit of 4.44 to 4.55 billion. That's slightly higher than what the street was expecting.
Meanwhile, I take a look also at Paramount Skydance reporting earnings as well. And you can see that the market reacting favorably here. Shares about 5% after hours. Interesting to get some fundamentals here. Their first quarter operating income coming in at about 160 or so. Of course, this has been a deal story, so it's interesting to actually get to what's actually going on with the company.
Keep an eye on Semi. I mean, they did beat and raise in the most recent quarter, but you see the negative reaction on the shares, and we're actually going to have the CEO of On Semiconductor on this program tomorrow, right here from Milken.
Looking forward to that conversation. Certainly a lot to talk about, but let's talk a little bit about another big market, and that is the prediction markets, because our next guest served as commissioner of the CFTC from 2017 to 2021, and currently he sits on the board of Kalshi, which is the most popular prediction market in the world. His name is Brian Quintenz, and he joins us now. Brian, great to see you.
Thank you. Nice to be here.
So I want to start off with a political question here, and I want to start with some comments that we recently got from President Trump talking about prediction markets last week, saying that the whole world, unfortunately, has become somewhat of a casino. You look at what's going on all over the world, in Europe, and in every place. They're doing these betting things. I was never much in favor of it. I don't like it conceptually. And I wonder, when you think about those comments, how you see the political landscape sort of evolving as prediction markets just become more and more ubiquitous in our society.
So I think President Trump really cares about the little guy. He doesn't want to see the little guy get hurt. And the wonderful thing about these markets is that they are truly markets and they are not casinos. You're not taking a side against the house. The house isn't setting the odds. The revenue of the company isn't equal to the customer's losses. These are peer-to-peer trading venues where the information provides real-world value and real-world hedging opportunities to businesses, entities, and individuals in a new way.
Well, I hear what you're saying, and certainly that is the grand hope for these prediction markets. But you think about right now, I think 90% of your volume is sports right now. So how do you sort of boost the share of some of those more economically valuable markets on Kalshi?
Sure. Actually, the volume of sports has come down from about 90 to 70%. And I think just the popularity of sports and the frequency of sporting events contributes to that. I think as we get closer to the election cycle, we'll see that category significantly increase. But obviously, people engage with markets when they feel like they have an edge. And these are markets where individuals actually do feel like they have an edge and do have an edge over big Wall Street firms like they don't do in the stock market.
I am curious, though, particularly on the sports side, and obviously you have this weird situation where obviously primarily regulated by the states, but you have Kalshi kind of able to operate outside of that under, you know, to a certain degree under federal jurisdiction. The states complain, they say, okay, we're losing $600, billion in tax revenue off of this because of that competition. Where do we get some sort of equilibrium in the way that a traditional sports book is treated and the way a Kalshi or another prediction market is treated?
So I think both models can coexist. I mean, Kalshi is a federally regulated derivatives market underneath the purview of the CFTC, the derivatives regulator that's been around for 50 years. Sports books and casinos can operate at a state level if they're legally allowed to. But individuals are free to engage in a federally regulated marketplace. And I think what we've seen is that the revenues of both have gone up. The trading activity in both the marketplace and the betting activity in casinos has gone up. So I don't think it's really a zero-sum game.
But so you would be okay, I mean, I know you're not at CFTC anymore, but you think regulators would be okay if Flutter, if DraftKings or one of those companies just started a prediction market under the purview of the federal regulations as under CFTC without any regard for the state regulations?
Actually, they are. DraftKings and FanDuel are already doing this. But I fundamentally think it's a different model. Again, it's a marketplace. These are exchange operators. They're bringing people together to trade. You're not betting against the house where customers' losses equal revenues for the company.
I do want to talk a little bit more about, the idea of bringing in more institutional investors and users onto Kalshi, because there's a lot of interesting use cases there when you think about hedging, some of which you mentioned. But at this point, I mean, how much of that is a thought exercise versus, something that's actually happening on your platform? What is the breakdown roughly when it comes to the institutional side of things versus some of these retail players?
Well, the institutional side's grown a lot. It's actually grown 8x since November. So we're seeing big players, hedge funds, insurance companies come into this space and use these markets. But another really fascinating thing is that out of all of the users that have accounts that we have, that Kalshi has, 70% don't trade. They come in to just look at the information, to gain insight into what's going on in the world and what those market probabilities are, to incorporate into their decision making, to understand whether or not now's a good time to buy a second home, to finance a car, to take a vacation. This is really a new information economy that's being built.
Brian, really appreciate you taking time for us.
Thank you.
Brian Quintenz there, board member over at Kalshi and, of course, former commissioner on the CFTC. All right, coming up, we're actually going to take a closer look at, surprise, alternative investments. It's a big topic here at the Milken Conference. We're going to catch up with Oak Hill Advisors CEO Glenn August. That's coming up next here on The Close from Milken, right here on Bloomberg. Welcome back to The Close here at the Milken Institute Global Conference in Los Angeles. Now, our next guest, he co-founded his firm back in 1987, the year of the market crash, and he spent 4 decades almost navigating every credit cycle since. Now, while his competitors are being accused of putting up gates, he's actually opening up doors, launching in a retail fund directly into the teeth of the private credit redemption debate. Glenn August, founder and CEO of Oak Hill Advisors, joins us now. Glenn, great to have you here.
Good to see you.
Just about a month and a half ago, you launched a new product along with T-Row, your partner here, at a time for retail investors, we should say, at a time where it seems like retail sentiment, at least when it comes to private credit, is kind of at a low.
So, look, I think...
Is that hubris? What's going on?
No, it's opportunistic.
Okay,
all right. It is, okay? And so often when markets have more sellers than buyers, that's when the buying opportunity is. And so what I would say is that the market for individual investors to have exposure to illiquid credit, private credit, makes a lot of sense. And I do think there's been a narrative that's been a little hyped on the negatives of private credit over the last. Please go.
Use the phrase illiquid credit.
Yes.
Some of your competitors don't use that phrase. They call it semi-liquid or some other thing.
So here's what I'd say. Private credit is placed privately, and the general strategy is to hold it, not to sell it. And for that, you capture an illiquidity premium of 150, 200, 250 basis points. We have billions of dollars of institutional investor capital who have long-dated capital, and they buy into illiquid, less liquid assets to capture that 150 to 250 basis point premium. And the non-traded BDCs were designed to do that. And unfortunately, when the market had concerns over software credit, a lot of people ran for the doors, but the product was designed for 5% redemptions, not for 20. And if it was supposed to be designed for 20% redemptions, then the manager would hold 40% liquid assets to serve them. And so I think there was a disconnect. Now, I happen to think we're getting through this. I happen to believe that illiquidity premium makes sense for investors, which is why we launched this new product. It is not only senior direct lending, it is opportunistic credit, it is asset-backed, it is structured credit, it is some stressed situations, and it's the best of what Oak Hill has been doing for the last 40 years. And I believe if you can capture illiquidity premium and the investor understands the terms of the deal, then that's a great opportunity. If you think about private credit, there's $1 trillion held by institutions, only $300 billion or so in non-traded BDCs. And so there's so much talk about what's gone on in the non-traded, but institutional investors have been allocating to the asset class for years. Last year, we raised our biggest private credit fund. We raised $18 billion of capital because institutional investors believe in capturing the illiquidity premium.
Well, part of the reason, we talk so much about it is because, you think about the conversation probably being had at this conference last year. There was such a big push to open up private credit to that retail cohort, to that, new sort of addressable market of investors. And you mentioned, I believe it's 20% of what we're talking about is actually in retail hands here. But do you think that number comes down as a result of this episode?
No.
Tell me why not.
I think over time it goes up. No market in the evolution of a market is a straight upward line to the right. And fundamentally, if private credit makes sense, which for decades institutional investors, especially in the last decade, have said, I want to capture that illiquidity premium, and that's why they've increased their allocations to private credit, then shouldn't the individual investor have an allocation for their portion of their portfolio that they don't need liquidity for to capture the compounding benefits? And so I believe over time that the individual investor will own more alternatives, not less. I think this little test here in the market with, again, we've over 4 decades, as Romain said, we've navigated stock market crashes, we've navigated Gulf wars, we've navigated COVID, we've navigated the energy markets when they went down from $100 a barrel to 28, and the high yield market was 15% energy, with the telecom, Enron, WorldCom, the whole fraud of the early 2000s. And so the markets navigate that, but ultimately, if you can pick credit well and consistently, then you earn credit spread. And if you can basically get illiquidity premium on top of that, you make incremental returns. And so I believe the individual investor will want to own more. And I believe we're at still the early stages of it. And so, yes, a little bump in the road. Yes, people tested liquidity of the vehicles that were not designed to provide substantial liquidity.
Right.
And we're going to get through that.
Right. I mean, you think about the postmortem of what happened in the first quarter. It seems consensus here that these vehicles performed as sold. That 5% cap, that is a feature of these funds. But how do you make sure that the, individual investors who are ending up in these products actually read and understand the fine print?
Look, investor education is of paramount importance. It's our job to make sure that we provide the information. It's every person along the way. And I will tell you, the investor education is going up dramatically. And so, again, I do think we have weathered this moment. I do think ultimately it's going to be what happens in terms of AI disruption. And again, my view there is that there's winners and losers. And we've re-underwritten our portfolios and believe while we have some, we'd be foolish to say we have no AI risk in our portfolio like any public equity or private equity manager has. We feel good about what we own, and we think this is a chance to actually differentiate yourself. And so for a product that for a while was being viewed as a commodity product, we actually think there's real opportunity to show differentiation.
But would you say weather past tense? I mean, you think that we sort of seen the worst already in this, or is it going to take? Because I mean, AI is still, as you know, a developing story.
To be clear, what I mean in weathering this rush for the door to get out.
Gotcha.
I think that the AI story is being written in front of our eyes, not just for public or private credit, but for all markets. And it's going to continue to evolve. And there will be products that come out that are truly disruptive. And there are industries, segments of not just software, but accounting and legal and other services that will get impacted by AI. But this is going to be evolving. In the interim, what we're seeing, Romain, is really good reporting results from our companies. And again, remember, as a credit investor, we're senior in the capital structure, we're current, we have amortization, we mature, and so we feel good about what we own. But yes, this is evolving. This is not the weathering part. I think is the shock to the retail channel in terms of redemptions.
Well, I do want to just kind of put this in historical context. So we talked about your 40 years doing this. You sold to T. Rowe Price back in 2021. I mean, how does somebody like you, with this sort of private credit, alternative asset DNA, fit into, let's face it, one of the more boring traditional asset managers? And I don't mean that as a compliment.
Wow.
I mean, the first mutual fund, that's how old I am, Katie, right? The first,
you're
before
not that old.
ETFs.
Stop.
The first mutual fund I ever bought was at a little T. Rowe Price shop. And how do you fit in?
First of all, while we quote unquote sold the business, we view this as a partnership. As you've known me for many years, we are still firing on all cylinders. This is not about selling a business, it's about growing a business with our partner. Secondly, we really do have, notwithstanding your commentary, a great cultural fit with T. Rowe. They are so focused, active investors, fundamental investors who care immensely about their clients, and they're good people with good values. That's how we feel about our business. And so, to me, the opportunity to partner with T. Rowe in bringing products to the wealth channel, in bringing products ultimately to the retirement channel, in partnering in insurance, where they have a lot of attraction to insurance partners because of the size of their retirement business. It's a great partnership, and yet we've been able to retain the independence of our investment process and our team. And so it's been, for me, an exciting partnership.
All right, Glenn, that's a good place to leave it. Really great to get some time with you. That
Thank
is
you.
Glenn August. He is the founder and CEO of Oak Hill Advisors. Really interesting conversation, especially
back in my day, Katie
go on,
Greifeld,
go
there were no
on.
ETFs, all these fancy products.
Yeah.
You had to go in there. You couldn't even do it online.
I know. But now ETFs, they're taking over. And I am so excited for our next conversation because we're going to be speaking with the CEO of State Street. His name is Ron O'Hanley. We're going to talk about trends he's seeing in the markets, but of course, we're also going to talk about the ETF business. Of course, State Street, home to SPY, one of the oldest and biggest ETFs out there. This is The Close, live at Milken, right here on Bloomberg. Well, in his nearly 4-decade career, he's worked for Fidelity, he's worked for McKinsey, he's also served as vice chairman over at BNY Mellon, and now he's the chairman and the CEO of State Street, which has $5.6 trillion in asset under management as of March. I'm pleased to say that Ron O'Hanley, he joins us now. Ron, great to see you in person.
Katie, it's good to be here. Romain, it's nice to be here.
Hi.
So there's so much I want to get to, and I want to start actually with how you approach partnerships, because State Street is really interesting that, especially when you think about your ETF business, you've been very active in partnerships. You have joint products with the likes of Bridgewater, Apollo, Galaxy, the list goes on. And I wonder how you approach, partnering with others versus outright M&A.
Well, we start with what we have, which is we've got a leading ETF platform. State Street invented the ETF. We had the first ETF out there. And as ETFs have become the vehicle of choice, we've recognized that that platform is available not to us, but to others, and that we can pretty rapidly bring products to market almost faster than we could through M&A or organic development by working with some of the best managers in the world. So the partner model has worked well with us, and we'll continue to do that. I mean, in terms of M&A, M&A is episodic. There has to be a meeting of the mind between the buyer and the seller, and it has to make sense for shareholders. This is a way that we can bring things highly tailored to market pretty quickly.
Right. Well, let's talk a little bit more about your ETF business. You mentioned SPY. It's one of the largest and oldest ETFs out there. But I think about the State Street ETF business overall, and your share of that industry has been slipping for about a decade now. You have the likes of BlackRock and Vanguard really ascendant when it comes to the industry there. So how do you reverse that? I mean, you've gotten more aggressive with the partnerships. You've gotten more aggressive with the launches when it comes to the last 2 years or so. But how are you thinking about, again, how you reverse that decline and just where ETFs sit in the overall business of State Street?
Yeah, well, part of what you have to look at over the last decade is what's happened to ETFs, right? ETFs have exploded. Like I said, it's the vehicle of choice. So when we started out, there were institutional buyers, and today we still are the largest provider to institutions. What happened over the last decade was the entrance of the retail investor into it. And Vanguard and BlackRock went into that sooner than us and really did get ahead of us. But for us, our core market segment is the institutional investor. At times like April of last year, when there's all sorts of turmoil in the market, our ETFs will by far be the largest vehicle that's traded in the marketplace. So that's the core franchise that we want to protect. And in the meantime, we've aggressively grown what we call the low-cost segment, right? This is the buy and hold segment where something like SPY, where it's got these very narrow spreads, is not that important to a retail investor. They're looking at fee. And so we've got a low-cost lineup in there. And last quarter, the low-cost version of SPY.
SPY-M.
Yeah, SPY-M was the largest ETF asset gatherer in the world. So for us, it's retaining and growing that institutional segment and then making the kind of investments that we are in the retail segment.
With some of the other businesses, though, I mean, you've been integrating liquidity and FX and securities lending under kind of that State Street markets. Is this kind of a play to kind of actually compete with the bank trading desk, or are you still going to kind of hold on to that custody role?
Everything that we do in markets is related to what we do in custody and asset servicing, right? So we're not out there independently taking kind of principal positions. It's all to facilitate that business. And what we've recognized is it's easier for the investors if we can provide all that for them with not just the traditional channels, but with the electronic channels, and be able to provide it on a low-cost basis. And today, in terms of real money foreign exchange, for example, so as opposed to principal foreign exchange, we are the leader in that.
I do want to talk a little bit about geopolitics, particularly in light of your most recent results. The FX trading business, obviously on fire. So I think it was up 29-30% or so. Was that all a function of basically what was transpiring in the Middle East?
It's a function of two things. More volatility. You'll see higher volumes. But back when there was no volatility over the last 5-7 years, we worked hard on product and technology distribution to basically create new relationships. So we've basically grown volume. And that's the piece that nobody really focused on in our earnings over the last 2 quarters is we've hit record volumes each time. So it's not just about the dollars and cents, but it's actually the number of trades that we've done. So, and that's been really important to us, is building share in that business.
You know, it's funny, I actually started at Bloomberg as an FX reporter in 2016, and there truly was no volatility in the FX markets. You had to really beg people to read your stories. Totally different world now. I want to talk a little bit about AI, because you've mentioned that, you know, when it comes to the second half, that's when you really should see AI start scaling for State Street. And I was reading through your earnings call, and you know, a lot of analysts want to know what's going to happen in July. What are you going to say on the July earnings call? So I'm going to try here, too. I mean, what benefits should we be on the lookout for when it comes to how State Street is sort of looking at AI?
So maybe a little bit of quick background. So what we've done over the last several years is be able to invest in the business at a very high rate, basically by improving productivity and using some of the old productivity tools, machine learning and things like that. And we've reinvested that into the business, which in turn has grown revenues. So you've seen our revenue growth over the past, it's been 9 quarters now of expanding margin. And it's all about this, be productive, reinvest back in the business, grow revenues. AI, not just for us, but for everybody. You've got these incredibly powerful tools for a business like us. It will all be about how effectively we can implement AI. As I've said earlier in my panel this morning, if the technology never got any better, it'd still be a really powerful tool. It is getting better, and it's all about how you implement it and how you are willing to change your operating model, and that's what we'll talk about in July.
Absolutely. Well, looking forward to July. And, before we let you go, I do want to ask another really wonky ETF question. And you think about SPY, as I said, one of the oldest and largest ETFs. It's actually a unit investment trust. It's not an open-ended ETF. It's a similar situation when it comes to the Qs, which is held by Invesco. But Invesco was actually able to convert the Qs from a unit investment trust into an ETF, unlocking a whole ton of revenue in the process. Is that something that's under consideration at State Street?
No. I mean, we're happy with the way it is now, and we're much more focused on the product diversification that we're doing and recognizing that SPY is a tool for institutions, and we'll have companion tools and companion products around that.
Ron, really great to have you.
Thanks very much. Good seeing you. Thank you.
Ron O'Hanley, the CEO over at State Street. All right, Katie, we've missed a few earnings that came down the pike here. We can kind of take a quick look at them here. Now, the moves in the after-hours trade aren't overly dramatic. Well, okay,
Unless you look at Pinterest.
Unless I look at Pinterest here. Why don't you take a look at that? What's happening there?
Yeah, Pinterest shares soaring right now, and you think about that reaction. Pinterest has been one of the, sort of up and down retail stories, e-commerce stories. Certainly you think about AI, one of the companies trying to sort of harness that as well. But you can see that, shares currently now 18% higher after hours. So investors, at least in the after hours, liking what they're seeing.
I'm curious about IAC too, which is rebranding as People, in case you haven't kept up with that there. But we talked about this empire that Barry Diller built and the idea of sort of just a sort of a change in the media landscape here. So something to keep an eye on there. Those shares down about 12% in the after hours trade. Now, we do want to get back to this parade of business and finance leaders walking across the stage here at the Milken Institute Global Conference. And that includes Rosalind Brewer. She has held the top job at Walgreens Boots Alliance. She's run operations at Starbucks, led Sam's Club. Today, she sits on the board of United Airlines, holds a limited partnership ownership stake in the Atlanta Falcons, and has returned to her alma mater as interim president of Spelman College, where she's overseeing a $500 million fundraising campaign. She joins us fresh off a panel here at Milken on corporate governance in a new era. Roz, great to see you here.
Good to see you.
Let's talk about your panel and corporate governance and the idea of what a board should be in this environment, because we've been talking all day about whether it's geopolitics, whether it's AI transforming things. What should a board look like these days?
A board should really reflect right now, this season that we're in, so much agility, but also too, this is a time where we can't be passive, and I mean like technologically passive. We've got to have that across all the different disciplines of how these corporations operate, and we're seeing it come up. It's not just a risk conversation, it's how are you responsibly integrating it across the company.
Is there talk, particularly when it comes to AI spending? I know everyone just focused on the big hyperscalers, but almost every company now has devoted a pretty sizable amount of their budget to this. Do you think that money is being spent responsibly? Are the boards asking the right questions of the executives and how they're deploying this?
I think there's still a lot of uncertainty there, but the best board members are bringing those questions to bear. They're taking their experiences from their real life, day-to-day job and bringing them to the boardroom. But what I will tell you is that the best boards are educating their directors. And so every opportunity they get, reasonably thinking through, how much does my board bring to me? And they're adding new types of backgrounds to the board.
Interesting. Well, talk to us a little bit about that. You think about some of those backgrounds you might want. What does that look like today versus 5-6 years ago?
It's great to see when boards are adding someone who's already been through a transformation of using AI. And there are a few companies that are doing that very well. I think it's also important that they're looking at two very different areas that you maybe wouldn't have seen at the board level. One is supply chain, because supply chain is really the area where AI is positively impacting that process. And I think the other is around data management in terms of how you view your customer. You can know so much more, so much faster about your customer than you ever did before. And those are absolutely great uses of AI.
Yeah, it's fascinating. And it's fascinating, too, to hear the comment on supply chains because, again, you think about that timeline I specified, 5 to 6 years, we had the pandemic. And now, of course, we have what's going on when it comes to tariffs and geopolitics. But I want to talk a little bit about succession because I have to imagine that's always a big duty, a big responsibility of these boards. And, I mean, you think about this year, we've gotten a bunch of big succession stories when you think about Disney, when you think, of course, about Apple. And I just wonder, you know, has the conversation there changed at all?
You know, it's interesting because right now succession planning is actually a little tough at the board level because when you look at most, what I would say, senior leaders, you have to ask the question, how much time have they spent in Washington? How many other industries do they know other than the industry that they're sitting in their day-to-day job? So that when they begin to think about making these very complex decisions and the global nature of their decisions right now, it's important that we take a look at that. So succession is a little tough at this point because also, too, the future is changing so fast. Do we have what we need in the pipeline? So I think this is a time for us to think about that long and hard.
We'll talk about the pipeline, the human pipeline. Obviously, you are the interim president of Spelman College, so you are effectively training our next generation of leaders. But there was an interesting study out saying that a lot of young people who are coming out of college now, they don't feel like what they're learning in college is going to be applicable in the real world because of just how fast AI and all these other technologies are changing everything.
Yes, you know, we just had some conversations with our early graduates, let's say 2 years or under having graduated from Spelman, and some of them don't feel as AI proficient as they need to be. Some of the things we're thinking about at Spelman is that how do we really focus on project management? Because that's one of the areas that right now, projects, right? One time you thought long term, now it's about the project, right? So can we get project managers out the door a lot quicker? We're also looking at general ed, you know, those basic courses that you come in. More math, more statistics in those areas, and also to combining disciplines like econ should maybe no longer be econ. Should it be econometrics and mix econ with statistics? And so they're much more prepared and can rise above what AI can deliver.
It's in that rethinking there, and you have a partnership, I think, with Accenture sort of design here to kind of, I guess,
we do.
You know, drag out, or I guess inject, if you will, more of that AI and technology sensibility here. But the speed, I mean, you've been involved with Spelman for a long time, so you know how higher education doesn't always move at the speed of light. And so I just want to know how quickly you can adapt, or is it just more just bringing in layers with an Accenture and other companies and other partners to help with that?
You know, I think the partnerships are really important because they're giving us really what we need to understand how do you make these changes in an environment that's just so deeply embedded. First of all, they're on an academic calendar, but also, too, they're so used to doing things in a certain way. And I will say that there's still a little bit of intimidation by AI and making sure that it's being used responsibly. You know, is there social justice in AI? And so that's something that we as leaders have to teach people and help them feel comfortable in that space.
All right, Roz, have to leave it there. Such an interesting conversation. Really appreciate your time. That is Roz Brewer. She is interim president of Spelman College, as well as the former CEO of the Walgreens Boots Alliance and Sam Clubs, as well as former group president and COO of Starbucks. Certainly a decorated resume there.
Interviewing her, I have to say, I got to step up my lapel game here. So
I wasn't going to say
that. I know.
I love it.
I like it.
It looks great.
Looks great.
Let's take a quick check on how markets closed out on the day, the first trading day of the week. We are fresh into May, and a little bit of a downdraft today. The NASDAQ 100 down about 0.2%. The S&P 500 down about 0.4%. You did see a bit of a sell-off in the bond market, and you can see that Brent rising by about 5%. Again, we did touch 115 or thereabouts earlier on Brent. We're right now just below 114, but certainly maybe some of that coming through in the equity market.
Yeah, and we talk about this idea that every time we get these, whether it, I don't know, these shocks or these surprises, the market's actually taken it relatively in stride. I mean, it's been pretty rare, even during this whole 2 months, where we've had a massive sell-off. I mean, there's been maybe 4 sessions where we really saw kind of a wholesale oil sell-off, but usually it's kind of just nipping around the edges like we're seeing here right now.
Absolutely. I mean, to the other end, we've also seen some like face-ripping rallies in the past month or so. So a lot of volatility to both directions, and at least for right now, a little bit of a downdraft when it comes to the S&P 500. But our next guest's career in financial services spans nearly 4 decades. Her name is Ann Walsh. She is Chief Investment Officer of Guggenheim Partners Investment Management, who guides the firm's investment strategies. And I'm thrilled to say that she joins us now. And it's great to see you.
Great to see both of you. Thank you for having me.
So let's start right there on that conversation Romaine and I were having. I mean, you think about these equity markets. March was a hairy month, but then you saw what happened in April. And you think about where we are when it comes to the bond market. Hasn't really retraced that sell-off. You think about where we are when it comes to oil. We're at very, very high levels relative to where we were a few months ago. Are you surprised by where we stand when it comes to U.S. public equities?
So I think that equities price in news, good or bad, rather rapidly. And what we're seeing, and if we go all the way back to the financial crisis, we go back to COVID, we're seeing this, or Liberation Day last year, we're seeing the snapbacks happen faster. The volatility is happening rapidly, and the recovery is happening with amazing speed. And that's really become a pattern for the equity market because of this pricing in. And right now, the equity markets have priced looking through the Iran conflict to its conclusion. And I think that's what's driving the equity markets, along with, dare I say, fundamentals. The storyline's pretty strong, and U.S. economy remains resilient and positive.
Absolutely, and it's worth noting. I mean, you think about the latest round of earnings that we got through. We got a lot of the Magnificent Seven out of the way. Certainly, this opportunity to focus on the fundamentals of corporate America might help explain what we're seeing in the S&P 500. But even still, if we were to stay around these levels when it comes to Brent, when it comes to WTI, I mean, how much longer can this sort of dynamic last, where you have pretty high oil and you have an equity market that is paying attention to a totally different story?
So there's a few things here. So first of all, the downside risk, the extended Iran conflict really isn't priced in at this point in time. So there is some room for volatility in the future. Our base case is that we stay elevated on oil prices, let's say around $100 a barrel for, we'll call it 3 months. And during that period of time, we sort of slowly then, towards the end, tail back down, not to pre-Iran conflict prices. We don't really see a round trip to 60. It's going to take a little bit of time to unsnarl the supply chain disruption that came from having the straits closed. And so as a result, we're going to see maybe 80, which is about where the futures suggest by the end of the year oil prices will go. In that environment, the markets can operate, fixed income can operate too, and we'll talk a little bit maybe about where the fixed income markets are. But that's where equities have priced in. Again, looking past the conflict to fundamentals and the ability of the economy to recover, remain resilient, even in spite of elevated oil prices.
Well, let's talk about fixed income. I mean, spreads are still tight despite, I think, everything that's happened. So, I mean, you still have some resiliency there, same way you see in the equity market. So I am curious, do you expect at all any sort of widening of those spreads as this conflict continues for a longer period of time, or do we kind of stay where we are?
So I think fixed income is now more of a rate story than it is a spread story outside of technology. And what we're seeing is concern about inflation and Fed policy, and by the way, central bank policy around the globe and what's happening there, and the concern about whether they need to actually begin to dare I say, raise rates. And our view is that we still expect one rate cut later this year, but obviously the markets have priced that out. And we have, assuming all goes well, a new Fed chair in Walsh, and so I think we're going to see a change to the way the Fed manages interest rates going forward and thinks about inflation fighting, using different tools or using the same tools differently, if you will. Right. And so as a result, I think it's more of a rate story. What else is also happening is, because of the Iran conflict and other fiscal spending that's happening, we're going to see more treasuries get issued. And so as a result, we're seeing sort of a lift to rates because of a supply-demand dare I say, imbalance. Way more supply coming relative to the demand, and that's lifting rates. That, however, isn't affecting spreads. So the spread story is one where the fundamentals, the same market conditions that are driving, dare I say somewhat optimistically, driving driving stocks are also driving the spread story relative to rates.
You mentioned how the Fed is going to maybe think a little bit different about inflation fighting, but there's also been a lot of talk based on what Kevin Walsh has said publicly, just about thinking about what inflation is altogether, at least in the context of monetary policy. When you think about whether it's productivity enhancements and other things coming into the economy, is there a case to be made that maybe the way we look at inflation at its current levels is, I don't want to say wrong, but maybe it's not the right way to think about it?
I think the issue is, do the tools that currently are the tools that are available to the Fed and to central banks, are they the right tools to fight this type of inflation? So if the inflation is one that's caused by supply chain snarls, I mean, to be real, there's a whole lot of oil available, many billions of barrels. But getting it out of the ground and getting it to where it needs to be deployed are two different matters. And so as a result, is the Fed using the right tools, or do they even have them available to fight that kind of inflation? I think the market is pricing in what I would call the pig through the python problem. So if all goes according to plan or expectations right now, what we're going to see is inflation bulge and then return down to at least some level that is closer to the Fed target. Do I see 2%, which is the Fed's target number, anytime soon? No. And in fact, we have to look at the bigger picture, which is, are we in a bit of a reflationary world anyway? All this building for AI, all this need for capital, these are different types of drivers than necessarily the Fed's situated to take care of. And so I think that's one of the reasons that Walsh is really interested in and has written a lot about how do we really address these tactically, and what tools does the Fed have available to it to address them?
So, I mean, how does that change your thinking about how you're viewing, U.S. government bonds as an investor? Because, you mentioned a whole lot of elements here, which sounds like it leads to maybe a structurally higher long end of the Treasury curve. Does that change any assumptions that you have about, what role that plays when you're putting together a portfolio?
So interestingly enough, what we've seen is a flattening of the yield curve, and I think what we're going to see is a lot more issuance in the short end. So perhaps what we're going to see is this flatter yield curve becomes a bit of more of a phenomenon relative to frankly, even our prediction that we were going to see a steeper yield curve. At the beginning of the year, that certainly made a lot of sense. Given where we are now, the flatter curve probably is the story. Oddly enough, also, what we've seen is the 10-year remains anchored, and it's been anchored running between high 3s and high 4s for a long time now, since 2022, really. And so as long as we're within that space, investors can actually tactically move duration, which is what we've done. As interest rates move up to the, say, 4.5 level on the 10-year, or maybe a little bit more, that's the time to extend duration. Frankly, the economy and tech and other markets, stock market, for example, really don't perform well when the 10-year goes north of 4.5%. So keeping it in that range, I think, makes a lot of sense, and I suspect that Fed policy and more likely Treasury policy will have a goal to keep the 10-year within that trading range.
With regards to Treasury policy, I mean, how do you rate it so far? I mean, I know there's a lot we don't know, but at least from what we can see, it does appear that Bessent has done a relatively good job so far of trying to thread this needle.
Actually, I mean, I think he actually has done a very good job, considering there's been so much headline news. There's been a lot of deficit spending. And they have to signal. The Treasury has to signal when they're issuing and how much. And I think it's been very transparent. And I think, in fact, the Treasury Secretary has done a great job.
All right, and always appreciate you taking time. Always great insights. And Walsh is the Chief Investment Officer of Guggenheim Partners Investment Management. As we wrap up, just day one, Katie Greinfeld.
We got a lot of days left.
Our extended special coverage of The Close from the Milken Institute Global Conference in Los Angeles. We had a great lineup today. We had an even better lineup tomorrow.
Absolutely. We're going to be joined by Manny Roman of PIMCO for one. Also Ken Kinsell of Churchill Asset Management.
And I'm looking forward to that. I mean, we were talking with Glenn August before. Obviously, an OG when it comes to the private credit space. I mean, Ken Kinsell, obviously, at the first Drexel conference way back when.
There you go. Yeah.
And we're going to hear from, I guess, a relative newcomer to the space. Katie Koch over at TCW is going to be joining us as well.
Yeah, so certainly a lot to look forward to there as well. And we're also going to be keeping an eye, of course, on what's going on in these markets, bringing you these conversations and trying to put together a whole bunch of different forces right now, Romain.
Absolutely. We're pleased that you joined us here. Stick around. A lot more coverage coming up here from the Milken Conference right here on Bloomberg. Katie and I will be back tomorrow for The Close on Bloomberg.